Check, check, 1, 2. Coming live. Just let me know if that audio is coming through. I think we should be ready to roll in about 7.5 minutes. Thanks, Rory. Cheers. Hey, Eds. We've got A-Cut, Arizona. Got Zane. Awesome. Well, I'll kick off shortly. Great to have you all on. All right. Good morning, everyone. Hope everyone's well. My name's Tim Fairweather, and I'll be hosting the Books Price Action webinar for today. Who we got on the line? Got some of the usual suspects from Orlando as well. G'day, Pierre, Ed, Rory, hi Joe, come Dad, A-Cut, Arizona, good Zane, fantastic, good to see you all. Look, it was great to catch up. Okay, here. Yeah, great to catch up with everyone in Orlando. If you've got any selfies that you took with me, please feel free to send them to me on Discord. I was in a lot of pictures, but my phone was kind of sitting around, so it'll be great to get a copy of those. It was awesome to meet people from all around the world, hear about everyone's trading journeys, and commiserate over trading mistakes and those kind of things. So yeah, hope everyone found it valuable. Just on that note, I'm sure Richard we'll send some messages on Discord, but we've got a survey for that event. We'd really appreciate your feedback. We took all the feedback from the first one very seriously and did a lot of improvements. We spent a lot more on, AV and audio. We've got some great video guys there, more screens, better IT, better planning. So yeah, let us know how that goes. Fantastic. So what I've got here, just on the daily chart, I've got a Globex chart up at the moment, and I've just highlighted 81 bars. I want you to imagine that this was a day. And what I'm looking at are reasonable swing entries and then reasonable targets for those entries. Because we've got a situation now on the daily chart where we've got a parabolic wedge, we've got about 3 or 4 legs up, and very bullish, gap to the moving average, and it's following this pattern: breakout, sideways, breakout, sideways, breakout. So basic pattern recognition would say, well, today's going to be a sideways day, a small kind of doji. And a lot of the time you'd be right, but I think the best approach for a bias is to have the other side ready to go, which is it's not going to be a small day, it's actually going to be a bit of a surprise, which could be another one of these days. So I want to kind of have those two in mind. I've highlighted a couple of 2-to-1 targets on the daily that were magnets I was looking at. So one possibility is we kind of oscillate around those. And yeah, I just want to work through some of these. So let's imagine you took that swing entry. Okay, so they got 2-to-1, so they're pretty happy. They got 2-to-1, took some profits. Maybe they swung a little bit more. These guys got 2-to-1, they're happy. At some point, someone's not going to get 2-to-1. So they were the last people to get 2-to-1. Okay, so now what's going to happen to these guys? Because I think it has a very interesting effect on your trading when you realize that if you're waiting for probability, okay, which means you've got a setup and you're hesitating, what you're doing is you're increasing probability, but you're reducing the reward you can potentially get. Because someone that took a buy here is going to get more than someone that took a buy here. And what I've seen in the trades that people have sent me is that they've bought really late. They've bought 4 or 5 bars into a bull spike, and they've put this big 2-to-1 target on the top. But that's okay as long as you're willing to expect this to happen there. So can you see there how they were the first bulls not to get a 2-to-1 target? Oh, sad face. And how do they then respond? Well, one way to respond is that your entry is here. You don't move your stop up because it's likely to get tested. And you can see here, got tested and then went back to the 1-to-1 target. So there's your 2-to-1. You miss. A lot of those traders try to take 1-to-1. You get a second chance. They then get to take a break even. Other traders will buy this. They'll trade small and they'll buy more below. But it's interesting to look at that example because I want to do the same one here and see what happens to these traders. So does that make sense to everyone? And the daily chart has, 81 times the volume of the 5-minute chart. And I think it's a really useful place to to start. So here we've got traders that bought this bar, good looking bull bar in a bull trend, above both moving averages, high 2. Yeah, nice, thanks Roy. They were looking for 55.38. Okay, they got it, brilliant. TradingView have added this annoying little text function onto their bibs. It's a bit annoying. Okay, this was the one I was looking at today. So this was another good bull bar, classic Al Brooks here, big bull bar going from the moving average up, closing on its high, buy, wide stop, try and add on. So they're at their 2-to-1 target. That's good. Interestingly enough, see how all three of these bars are converging at the same point in this kind of 55.48 to 55.62. There's about a 10 to 20 point range. And that's what I was looking at this morning when I was thinking about the session, is that you've got the last three really good bull bars have all hit a potential target. So my first instinct was, oh, we'll definitely go sideways. The other possibility is actually all these other bulls are going to get their targets as well. So their targets will be a little bit higher, 55.80, but I'm going to put two of those targets up there. So if that makes sense for everyone as well, that's why I've got those two targets up there, because, you know, I think it's really useful to study the higher time frames, because it takes, I think, a little bit of time to get the fractal nature of the markets. Doesn't matter how many times someone says it. When you can see any time frame chart, like at the 5-minute, that's when trading will actually kind of make much more sense. And then you can pick a time frame that you can read clearly, and then just trade that time frame. But 5-minute is a great training ground because it's got time pressure. So these guys didn't get 2-to-1, pulled back. So at the moment, no one's kind of in that situation. You can see even here, if we put the targets there, they didn't get 1-to-1, but big bar coming very late in a trend, 1, 2, 3, 4, 5, 6, 7, 8, 9. It's the 10th buy signal. And so if you're looking at your trades and you're waiting 10 bull bars before you buy, then your issue is probability and risk reward. You can only buy this if you can handle a stop down here. Otherwise, let it go, wait for a couple of legs sideways to down, see if you get another buy signal. You can take the first one with a wide stop, or you can take the second one with a tighter stop. Pretty much the same trade. And then you only have to wait 1 bar. So you can see these traders here, you buy there with a wide stop, never got challenged. Back to the moving average as expected, sideways, there was no reason to get out of that trade. For more intermediate traders, the other approach to taking this trade is you buy here. A lot of traders will say buy below that bar. That's fine. But I think in a later leg, a better strategy is to buy 1 times the signal bar down, because that allows the bears here to get a scalp. So the reason you want those bears to get a scalp is that then the pullback has finished. So this pattern plus pullback, pattern complete, breakout mode. If you scale in under that bar, which those traders did, can you see how we kept going down? And what will often happen is you'll have to go down to a second scale point. And this is usually where newer traders exit the trade. But a lot of these bulls who had an order to scale in here didn't get filled. And if you are newer to trading limit orders, or you're trying to improve your skill in limit order trading, this is very valuable information. So if you've got a credible place to put a limit order scale in that doesn't get filled, what does that tell you about the bears? Well, they're just not able to get price down there. So you're not worried about dojis here. You're waiting for a reason to buy. And let's contrast that. With taking this buy here. So you buy there. Traders that bought lower had a chance to get our break even. Pretty good idea after that bear bar. But you had a chance to scale in 1 times lower, do the same thing. You're basically hoping for this, but you know sometimes you're going to get that. Because the worst thing we can do in scaling is to add positions too quickly, and then we have to get out when we need to be adding on. So. How I'm measuring? I'm just measuring from the low to the close. Low to the close. Some traders will measure one tick below, one tick above for the fill. But here I'm just looking at the close for simplicity. On the 5-minute chart, I think that gives you very accurate measured moves. But I think for most traders, just to look at where that 2 to 1 is. When there's gaps, obviously that trade can't get filled. So you've got to look at other areas. But yeah, I'm just doing that. Yeah, stop under, and then one tick above. So daily chart, 60-minute chart, I've highlighted these bull spikes, and the reason is I want to be very careful if there's a bear spike here that I don't get sucked into selling too low. I want to make sure that if there's bearishness, I see that it can be a pullback from this and not right away be kind of driven short. I prefer then to wait for a breakout pullback, but I want to keep that highlighted because you can see wedge bottom, sideways breakout, and then same possibility again. Even though we've had a couple of legs, the bears need to do more to break this. And Matt, do traders use swing stops on the daily? Yeah, absolutely. I'm not sure if I answered that question. I understand that question. So if you're trading a high time frame chart, you need a smaller size and using swing stops. It's actually much more relaxing than the 5-minute chart. All-time high on the monthly, full spike, pullback, and then potentially measured move up. I think it'll be too far away for today. Even if you took it from that high or low. Oh, there we go. You're 5680. Okay, so a little bit far away for today, most likely. Tight bull channel, micro gaps on the weekly chart. So consecutive bull bars expected to go above it. More likely buyers below 54.89. That's also about 100 points. I might just put a line there anyway so we've got it on the chart. It's going to be low one into what you see on the weekly. Kind of a weak buy signal, rocketed up, and that means if we're going to form a trading range, 5,500, 5,508 is an okay target. But at the moment, bears don't have a sell signal on the daily, on the Globex. The only kind of sell signal that makes sense for counter trend traders would be this bar. You could argue first reversal unlikely. A breakout of that range would be 55.30. So I'm just trying to get a sense of where a scalp target for bears would be. It also happens to be a bull micro channel, and we're under the last strong bar. So I put a little green box there, potentially. Let's get off the ETH chart. Yesterday, an interesting day. So we had, coming into the morning session, hang on, it's not going to work for us. Let us know where you bought, where you sold, how'd you go. We went from trading range the day before, trading range open, into a very strong bull trend. I finished my session in here. I had a couple of good trades, and I thought, hey, I've traded Euro well. I've got a couple of good US trades. I won't push it, and which is a shame because it was just a very strong bull trend for the rest of the day. But you get that. So you've got a really tight trading range in here, and if you think about how traders trade in this trading range, bull channel, expected 75% chance it's going to have a bear breakout, which it does. New highs, new lows, new highs, confusing. So what traders will do will expect basically climaxes to areas of value. So consecutive bull bars, great. I thought it was a reasonable place to buy if it wasn't sitting in the middle of this trading range. If it was, down here after a bit of a wedge, that's great. If it's after breaking out of some highs, that's great. But right in the middle, it just says, I need to scale in. So anyone buying there needs to be okay with buying 1 times below. So I didn't take that buy. I actually took the sell. I thought that might trap people. I just happen to be right. Sometimes I'm not. And, you miss out on a good trade. And so I had this area marked because I thought, okay, anyone taking that trade needs to scale in. But they didn't need to scale in down here. So by the time we got all the way down here, traders sold. If you use the correct stop, you're okay. Second entry short. And I took this buy here. And after 3 bear bars, you can say, why would you take that buy? And that's because these bulls didn't need to scale in. So in the same way that we were looking on the daily chart, those bulls didn't need to scale in. Well, we didn't get down there. Now there's a buy signal. It's a second entry long. And that buy set the tone for the rest of that day. And I call this kind of trader agility. You're watching to see how people are acting, and I can't verify it, but it happens often enough and it's repeatable enough for you to build a trading system off it. So even if you didn't take that buy, ran the stops of the bears, you had a chance to take another buy here. And that put an end to that trading range, and then we had a bull channel. And if you take that line all the way across, and we get rid of all this stuff, where did we open at yesterday? On the top of that range. And it can be really difficult to see unless you've kind of done a bit of work to kind of get into the head of what's happening in here. Okay, traders bought that, looked like trend from the open, got trapped, didn't need to scale in. Trading range, higher low, new high. Now we've got high twos and all the bulls are making money. Double bottoms, every double top fails, double top failed, double top failed, double top failed, double top failed. We're in a bull channel. And it's really common for it to come back and test the top of that range. So if you saw 4 and you sold it, yep, fair enough, that can happen. If you see 5, 6, you need to exit. And what's great in trading is that usually if you do something reasonable and it fails, if you can switch fast enough, it turns into a great trade, you can make it back. So you can see that everyone that sold there saw 3 bull bars and went, no, I'm wrong, I'm out, don't need to let my stop get hit, and I'm looking for a buy there. So if you didn't want to limit order there, 14, 15, somewhere in these 5 bars you can buy, 18, 19. Some traders will wait to see what happens. They know really likely we're going to get an opening range breakout. So as soon as they're seeing 18, 19, they're like, okay, well, I can buy there, put a stop at 12 or lower, and have a shot. If you watched all this and didn't trade, that's okay. You've got a chance for a bull flag. Here's the bull flag. You're waiting for a couple of legs sideways and to go above the bear bars, 33, 34, looking for a second leg up. And if you can kind of break the open down into the various kind of flavors of trades that are going to pop up, here, more likely trading range, because this was a very tight range, but in a bull channel. So okay to trade both sides, but better to try and get long. Any buys in here worked. If this is too confusing, that's okay. Wait for a breakout, consecutive bull bars. Great, you buy hoping for a scalp or a second leg up. If you didn't do anything in here, okay, well, strong enough to expect a second leg. You've got a bull flag. You're waiting for the second decent looking buy signal. 27's too early. That's the high one. Wait for a second leg sideways just to check that the bears have got nothing. Bears have got nothing. 33, 34, 35. You can get all fancy with your harmonics and say, okay, well, I'm looking for some kind of distance that's about that. That works well. If you're not confident in the opening range, don't trade it. I know heaps of traders who just avoid the opening range. I know others that just love trading the opening range. So totally up to you. But if you do take a lot of losses there, you know, great place to get rid of those mistakes. No news on Forest Factory. G'day, Hugh. Yesterday I bought above 26 and closed during 36. How'd you buy 26, limit under 22? In a strong spike, first sign of overlapping bars usually becomes the magnet. You know, you can think of it as a final flag, but in the context of a strong leg, which is probably going to have something similar. Oh, sorry, above 26, gotcha. Yep, high line buy, technically a bull bar. Yeah, I like it. I mean, it's strong enough. If you've got a wide stop, getting long somewhere in here is okay. And then if you get a really strong bear bar or a couple of bars coming out of it, you can just close and wait for the trend to resume. How about everyone else? Were people short here, long here? Oh, this is all low probability in here. So, if you take 5 or 10 points and you close and it goes another 20 points, wouldn't worry about it. My job as a trader is to take what I think are high probability trades for a scalp, so I look at my risk, or look at what both sides have, and then take a trade where I might have smaller risk and a bigger reward. For example, I was long here on 12, so micro channels, particularly when you're an inside bar, break out of inside bar, pull back to the entry point, and then I was going to close at the high. And then a lot happened in those 4 bars, and I was like, no, I'll take 0 or I'll take a profit. Fill or kill, as they say. And I thought to myself, that's a first attempt, and then that's the second attempt. And then on 17, I'm watching it going, okay, well, do I take my pennies and run, or is that enough to reverse? I thought, you know what? There's no way I'd take that reversal. So I'll wait. And then I actually had a buy order above it for when they'll get stopped out. So I bought more on 18, and then I think I took some off at 10 points, and then I think I got out somewhere up here. Usually I'll wait for the pullback and then one more bar. All above 26. Okay, so lots of people buying above 26. Nice. I'm going to assume that everyone else got cooked on this open if there's no other orders. This was a tricky open. The only obvious place to get long was down here, but if I move the chart across, difficult to put a buy order there when this looks like it's going to get a second leg down. And it did. It just got a second leg that was sideways. So we're going sideways on the Globex. I'm going to round about the moving average on the Globex chart. This is pretty aggressive buying, and so we might just be forming spike, pullback, and then a channel. If this is going to fail because of these magnets, I suspect it's going to need to fail from a higher high double top. And I can't prove exactly why that happens, but my best guess is it runs up and fills everyone's targets, and then there's no new bulls to buy, and then we just kind of drift back. There's what the measured move down here, and yeah, pretty tight in there. RTH chart, a lot of sideways price action in this bull flag, and so there's a magnet 5518. I think we're okay, so we're not too far away from that. I'm just way more comfortable having targets in both directions because my biggest losses have been on days where all the targets are just on one side. And that's what we call the pain trade. So the pain trades people are familiar with is you expect a spike to have a measured move. Okay, the high probability thing is for the breakout to have a second leg. So for example, this is a breakout, this should have a second leg. But the pain trade is that doesn't get a second leg, that actually gets a measured move below it. And that becomes a big problem. So here's a bull spike, traders buying and buy lower, expecting it to go higher. Oh dear, buying below, couldn't scale in. Now what happens down here? And you've usually got to scale in at an increasing size, but it's pretty dangerous because, you know, as you can see, you didn't quite get back to where you needed to. And easy to blow accounts that way. You think you can just scale your way and fix everything, but you can't fix a poor read of context. Yesterday, a buy climax. So on the encyclopedia, let's take a look. I'm going to bet it's BXYD. BXY. Oh, so close, so close. So buy climax yesterday. 25% chance of another strong bull day. And that's what I'm talking about earlier, about if it starts to do that, it's going to be pretty strong. You know, so we want to be careful if we're scaling into shorts. More likely, a little bit more up and then sideways. And 50% chance of some more buying in the first hour. Good to know. Here, spike into channel. 2 hours of sideways with some, you know, consecutive bull bars closing above the moving average. Reasonable to get long. Difficult to get short here. Selling below the moving average. Difficult to do in a bull channel. High twos. Here's the bull breakout of a bull channel. So 3 legs up and then sideways. So that's good to know. And that kind of looks a little bit more similar to what we've got yesterday. And then here, strong second entry short, probably going for the moving average and then just holding because there's no reason to get out. First reversal, second reversal, exit. Reasonable for bulls to buy again for test the moving average, and then we hovered around the moving average all day. So let us know which trade you took in terms of, you know, did you manage it? You think you managed it well, or entries, exit? I mean, trading's a motor skill, and it's really not about looking at charts. I think most of us spent way too much time on charts, not enough time in market replay, in NinjaTrader, or anywhere, actually practicing getting in, getting out, the timing, where does the order go, where to scale in, where not to scale in, how to get out break even. You know, the same as a basketballer shoots hoops, soccer player juggles the ball, you know what I mean? Sprinters practice their starts. Otherwise, as you increase the trading size, it'll just be way too many mistakes. Okay, so small gap up. Couple of points. We finished the day always in short. Okay, 1, 2, 3, 4, 5, 6, 7, 8 bear bars. So traders are going to be wondering if this needs some kind of second leg. So we have many legs up, paused, and then we've broken through swing points. So some traders will say, yep, it's a trading range on a high time frame, like the 15-minute chart, like the 60-minute chart. And on the 5-minute, they say, well, is it always in short? And generally, if there's no agreement between those two, it's better to trade it like a trading range. And that means look for a sell in the sell zone, top 50%, and look for buys in the buy zone. G'day, Alan. Bought 14. Yep, nice, nice. Held through the first breakout. Beautifully done. Yeah, 13 was good. If I wasn't already long 12, because, you know, and that happens, you know, your order doesn't get filled, I was basically prepared to buy the high one. So, sometimes your limit order sits there, comes down, doesn't fill it, and then rather than go, oh no, the market's so unfair, it's just to go, okay, well, there's a lot of other traders who didn't get filled there. You need to buy a bull bar, get long. Where'd you exit, Alan? Or what made you exit? I'd be interested to share. Yeah, that's why I exited as well. 24, nice. It's a good lesson, very good lesson to only trade when you're fresh. So can you buy here and say, yeah, well, the bear's got 3 bars on a 15-minute chart. That ain't enough to reverse this. I think you need a wide stop. 3 bear bars, bears should get a second something. Might be down, might be sideways. But I suspect we're going to run their stops. So I think we're going above yesterday's high. Remember, we're in an aggressively strong bull breakout, and that's a bull bar, so good chance we're going above it. Here's an inside bar. That's the last leg, which got broken. No new high. So trading range from 57, but not sure where the bottom of that range is. So bar 1 becoming a big bull bar. So trading range behavior. So anyone buying 68, 69, 70, you can see that same logic we were looking at before. 1 times that range down, you buy more. Now they're making money. And that's a really good discipline to have if you're looking to do something counter trend, is to go, okay, well, stop order bulls are having a hard time. Limit order bulls are okay. That means it's more likely a channel or the trend's still in place. So bar 1 closing on its high and immediately finding buyers. I like to wait for a follow through bar, particularly if I'm crossing the moving average here. We cross the moving average and then follow through. Okay, you draw a line there. A lot of traders thought that was a reasonable price. Here we cross the moving average with a close. Follow through is an inside bar, not on a reverse. Cross the moving average here. Cross the moving average, follow through. That's the line. Always in. A couple of tests, go higher. Cool question. Thanks, Matt. Can you identify where the breakout point for yesterday is? Do you have a hypothesis of when the start of the channel might get tested? Good question. So on the 60-minute chart, I think the context is a little bit clearer. We had a bull breakout. We had a couple of legs sideways down, probably a wedge. And then traders are waiting for basically a high 2 on the moving average or the bears to fail. And eventually the bears gave up. The bears kind of wanted this to be a wedge top, failed, breakout. So we're on a higher time frame breakout. And that means the breakout point can be, that's the breakout point from 2 days ago. But I think more importantly, because now we've broken out of this bigger structure, will be the top of that bull flag. So 55.19 is where I thought was reasonable. And in terms of this spike in channel, well, that was the strongest spike, so that would be 55.09. So potentially lower than that. But it's tricky because it's so strong on the higher time frame. Where's the first pullback on the 15-minute chart? Down there. Then we broke out of that range, but we never went below the low of a prior bar until here, 55.50. which kind of doesn't make sense on that pullback. So maybe 55.30, which is the low of that last 60-minute bar. If traders are long here, I think the goal is the top of this trading range. It's very rare for bar one to be the Walmart trade, as much as we'd all like it to be. That would put it into the 25% category of another strong bull day. I suspect this is going to relieve any of the bulls who are up here and give us a chance to see how many bears are selling up the top there. Because this is a parabolic wedge on a 15-minute chart, a couple legs sideways would be the first hour or so. So I'm not too psyched about buying up here just yet. Please feel free to type in your hypothesis for today. Oh yeah, Matt, let me know what you where you think that channel starts. I think we've also had 3 to 4 legs up on the 60-minute chart, so this could be getting a bit long in the tooth, as they say. But it's not a good swing short on the 60-minute, not a good swing short on the 15-minute. Without this hasn't tested the moving average yet. So I suspect they're just still scalp. So strong bull bar 1, pause 2, probably another big bar in either direction, but weak follow through. So traders who bought the close of 1, their 1-to-1 targets up here breaking yesterday's high. 55.17. Yeah, that's so similar to my breakout point up here. Yeah. 55.17. Yeah, that's so similar to my breakout point up here. Yeah. Another thing that's interesting about price action is when there's a couple of possibilities, often they'll all work. And as long as you manage them correctly, then they can all be profitable. First test the moving average on a 5-minute chart. Hasn't tested the moving average on a time frame lower. So at this stage, more likely in some kind of a bull channel, but a lot of bear bars, a lot of profit taking here. Oh, g'day, Ed. Yeah, the huge trend Thursday, Friday. Yeah, for those of traders that don't trade DAX, so Thursday, Friday looks like this. Right. So if we pull up a 24-hour chart, so this is what we call a low probability event. When this kind of big bar gets another follow through. And this is what we're talking about with the pain trade. So you've got strong bull spike, let's take the last bull bar there, and everyone says, yay, second leg up, buy more lower, everyone's happy. And you have an endless pullback, and traders are trying to buy below and scale in, and then eventually what happens is none of them want to buy anymore. Swing bears run all the way down to where their stops are likely to be. And these 2 days were very strong short days. But they didn't start that way. So if you look at the context coming into that day, I thought this was a magnet to get long, right? Strong bull spike on news. So I had a short scalp in here, and then I tried to get long, and then very quickly this bear bar set up, and then I wasn't too happy about that setting up. So I got out break even, and then I sold here for a scalp down, and then I think I took another sell, but I missed this bit because this was during the US session. But this day I did a bit better. Also a tricky open, spike, and then pull back to top 2/3, and then so I had a short scalp, and I lost trying to get long, and then I switched to selling, but I missed all this stuff here. So yeah, I managed to get a profit both days, but made a couple of mistakes. How'd you go? The only thing that really saved me was holding for 2 to 1. The bars were just like, all the bear bars started as bull bars, and then in the last minute kind of closed on their low. It's quite tricky. Hi, DB. Bulls 155 on the cash. Yeah, it's a good point. Big round number. And, where are the bear bars? Usually in a strong trend. And Ali presented this in his workshop at Orlando. Strong spike, and then here's a weak reversal. Here's a weak reversal. So you expect them to trigger and fail and run the stops of any trader that took it. Okay, so you just expect, so you're buying basically to run their stops. Okay, so you just expect, so you're buying basically to run their stops. So even if the bears can do something positive on the daily chart, potentially buys. So big bar and 2 pause bars. Bulls are waiting for that one more big bar. Volatility expansion, contraction. They want it to be one more big bar up. But now it's an outside bar. Traders have bought one, not getting the follow through they want. Traders have bought one, not getting the follow through they want. So a trader could sell above 2 and make 4 points, exiting below 2. So limit order market, and that's going to make it tough for stop entry traders. Not a huge surprise that we reversed at that magnet. Let's get rid of that. So I've still got the overnight. There we go. Let's do overnight. Let's get rid of that. 60-minute chart, bull micro channel and an inside bar. We went below that inside bar. I think we're going above that inside bar. A lot of Al's methodology is based off that principle. The traders want to see what's above and below a bar, and an inside bar gives none of that information. And so usually the market will go and test both sides. Above, below, above, below. This was the last trading range day, and just in case we have a trading range, I find the best policy is to wait for someone to get stuck. So my premise was this would not be a bull trend from the open. And if this rocketed up there, then I'm trapped out of the trade. But then I'm willing to fade the high one. The high one was above 5, and then you get a bull bar. And so I'm like, okay, well, if it's going to be a bull trend, I need to be willing to buy. But if it's a trading range, high ones and high twos are not buy signals, they're sell signals. And rather than sell above a good-looking bull bar, you very quickly got to go, okay, well, I'm not going to sell there. I'm going to watch 7, and as it goes down, I'll sell below 6 or below 5 or somewhere as it goes down. Now, sometimes it's just a small bar. Sometimes it does this. If you're not comfortable selling mid-bar, then you're just waiting for a pullback. Big bear bar closing on its low. You can sell the midpoint, sell the open, sell 3 or 4 points up into that range, just something less than the ATR. Bear breakout and follow through. If you sell there, your stop's above there. You've got to be okay with this pullback. You've got to be willing to scale in up here, which is what a lot of traders do. So you can see, sell higher, you're okay. Right, difficult to do. So 4, bear bar closing on its low, right above the moving average and right in the middle of this range. So not interested in selling below it. I think bulls want their profit from this buy. So looks like some took half R, basically half their risk. Your hit rate's got to be very, very good to be taking half risk. I'd only really recommend it in a late leg. Technically, you've got consecutive bull bars closing above the moving average, probably buyers above and below, but a lot of tails here. So I'm going to wait and see who shows up. Bears sold above a bull bar and made money. I'm expecting them to sell above this bear bar, but because I think we're going up here, it doesn't make sense for me to sell there yet. On 26 yesterday, it can be tricky because this is all sideways and then this is quite sudden. It looks climactic, it looks like it's going to fail, but then that's why it's great having a higher time frame chart like the 15-minute, and then you can see, you know, we've got breakout, follow through. These are a lot of closes, and this is more like a reset. And what that means is that you won't be able to trade the same size as the 5-minute chart, but it means you can have higher probability. And, you know, so you can take a small trade on the 15-minute, and then once you get better looking bull bars on the 5-minute, then you can go back to your regular size. That's one way to handle it. So sellers above 2 and more sellers above 4. So bull bar 5, so some traders just look at it as a high 1, or we've got bull breakout and a pullback. These bulls still haven't got any profit for their trade, and it's trading range, so it's likely we're going to go above highs, we're going to go below lows. I think you can only buy up here if you're willing to buy below 1. Because at the moment, there's traders are only scalping in here. Bulls need 6 to be a follow-through bull bar. They need to go to a new high. They need to break 57 from yesterday. One way to think about it is anyone that's sold 57 is more likely to sell more above it, and we need to put them under pressure for bulls. We're going to get our second 15 minutes bar as well. So first 15-minute bar, tail on top, no surprise. Any bulls that were long in here, scaling in lower, you know, 5 points below, 10 points below, what's that, 15? Yeah, 10 points below. There you go, 10 points. So you can see on the 15-minute chart, a buy scaling below, they're back to where they need to be. Let's take a look at the 60-minute chart. so we can get an idea. This spike we've got here finally gets a strong bear bar closing on its low. So we want a spike, sorry, no, I want the 15-minute chart. So strong bull spike, and then potentially a second entry short. Traders might say wedge. 1, 2, 3. Strong first leg down, testing the entry point, but more likely to go sideways. Let's see if we can find something here. So here, kind of a bear channel back down to the moving average. You can see too steep initially on the first move, needs a retracement for bears to sell. That's a bear move and pullback. We want a bull. Here we go. So wedge top on the 15-minute chart. It needed 3 or 4 bear bars to kick it off. So bear's got 3 bear bars here and a bear inside bar. So some traders are going to sell to close that gap below. So second entry short, but outside bar and at the moving average. So I think it's still only for a scalp. For me, I won't do anything on the moving average, so I prefer to wait. You've got bulls long on 1, long on 5, bull trend to bull bar. So as long as they're still in, they're going to scale in. Usually outside bars need a follow through. It's the same principle as before because you've got a bull breakout and you've got a bear breakout. Here, outside bar, no follow through. Counter trend, outside bar, no follow through. With trend, outside bar, follow through, pull back, second leg up. Trend, outside bar, follow through, pull back, second leg up. So you can see if it's a trading range, as soon as there's a stop entry, you have traders fading it. If the bulls can't get some kind of a follow through bar or a couple of small bull bars up here, then we might need this to play out. So the bears might get 5 or 10 points down here. Maybe close that gap. I think a great exercise for traders is to look at pullback depth. So here is a strong leg down, pullback nearly 100%. So if this is the trading range, bears have got 1 risk for 2 reward. Down here, bulls have got 1 risk for 2 reward. And my preference would be to be long down here, betting we're going to break out of the top of that bull bar on a high time frame. If this was a 5-minute chart, you saw 1, 2, 3, 4, 5 very strong bull bars closing on their high, open gaps, very little tails, and then you see a bear bar. Would you buy or sell below it? How do people go with trading ranges? Some people love them, some people hate them. For me, trading ranges was the first thing I actually understood properly. I was rubbish at trend trading and trend resumption, just fantastic in trading ranges. And FTSE has spent a lot of its time in a trading range, on a monthly, weekly, daily, so I had heaps of practice. And our second book, towards the back end of the book, Probabilities of Trading, that was the one that I read and I was like, that's what I'm meant to be doing. No one knows if it's going or higher or lower. All they're trying to do is structure a reasonable trade. Yeah, nice. Yeah, if you've got a program where you can set alerts, you know, at the highs or lows, or, you know, if you think of a particular pattern, you know, here's a parabolic wedge that's been going on for 19 bars. Probably need some kind of a pullback lasting about 10 bars. Okay, so it's in about 45 minutes time. So you can set an alert to say, okay, well, around about then, the pattern's probably done on that time frame. Or you have price alerts at the extremes. Other tips. Expect your first entry to be wrong. So if you're buying, you're expecting no matter how good the setup looks, it's probably going to be wrong and you're going to scale in, and it's the scaling that's going to make money. And that means if it takes off, you're generally on a smaller size than you want to be. Oh, that's okay. Oh, brilliant question, Matthew. Do you trade the tight trading range, or do you find other instruments with better price action? So for me personally, I have a problem with switching between instruments and maintaining my edge. So I will stick to FTSE DAX in the Euro and ES, the US. And if it's, you know, tight trading range, I'll make a cup of tea, get out the yoga mat, a bit of a stretch, and then I'll just come back and check the 15-minute chart usually. And sometimes I'll just pack it in, just say I'll come back tomorrow. Very easy to get stressed and suddenly take the breakout. Let's ignore that this was 78 in the day. If you're watching a tight trading range and suddenly you get a strong breakout, I had a very nasty habit of just buying the close, you know, it's just a dumb thing to do. But you sit there for a couple of hours and you think, yep, this is a breakout. You know, here's another classic one. You know, you're not short here, you're trying to get short, new high, new low, expanding triangle, can be a bull channel, can be a bear channel, can be everything. The reality, it's only going to be one thing, and that is a trading range. The moment you sell, the market turns. And the traders that did the right thing was to look at all these tails and go, yeah, probably going to go sideways at yesterday's low. I'm going to buy there, and then I'll take that last leg. I'll buy somewhere here, probably below that bull bar, and look to add on 20 points below. They did all right, and everyone that sold there got cooked. So another bull bar, so second attempt at a buy signal, probably going to be more buys above 7, but, you know, are they going to hold for 1 point, 2 points? So I talk a lot about mistakes, and I think everyone can become a good trader if you're willing to look at enough of your mistakes and clean them up, you know. And, you know, I spoke a little bit about it in Orlando with people. My mistakes were trading overnight, the Globex session. I was horrendous at that. I thought I was really good at that. Trading longer than 3.5 hours. And the other one was buying or selling the close in a trading range. You know? So, you know, you identify a few areas and you just avoid them. And all of a sudden, you know, you start having positive cash flow back in the trading account. And then you go, oh, actually, I can become a trader. The market's not trying to take my money, or, you know, it's not like people are trying to prevent me from doing it. I'm preventing me from doing it. So if you know what your mistakes are, please feel free to share them. You know, I started trading with a lot of capital, so, you know, I lost a lot of money on mistakes. So I can talk about them all day. Mistake categories, you know. One of the reasons I like Trader Tom quite a lot, you know, he's very, very open about his mistakes. Size and not enough wide stops. Yep. So consecutive bull bars, so still more likely for bulls to scalp up, but not willing to do anything with this, you know, all this empty space here. traders on one still haven't made money. So I'd be out. One of my rules is if it turns into a tight trading range and I wouldn't re-enter, then I need to be out. And 5 or 6 bars is usually enough. So yeah, awesome. Thanks, Matt. So size and not enough wide stops. So if you think about ES, the average bar range is about 5 points, 4 or 5 points. And on some days, it goes up. It could be 8 or 9. It could be 10. If you go back a year or so, it can be 15. So that's the first part of fixing that mistake, is checking the ATR, checking the bar range, and making sure that your stop makes sense. In a trading range, your stop's always going to be further away than you want it to be. In fact, in a trading range, the buy zone is where the stops are. And that means your size has to be very small, so you can't put a stop under 7. It doesn't make sense. And the other thing that gets with wide stops is, here you're buying in a late leg, right? It's late because it's probably had, 2, 3, 4, you can't even count how many legs are here. Lots. And then you have compression of volatility. So triangle, possible final flag, and then a spike. So the buy is not here. The buy is a breakout and follow through, probably up here somewhere. So having a wide stop here is a bad idea, because this is probably a late leg, and the traders that bought there have to scale in lower, and bears are going to do the opposite. Sell, great risk reward, going for their scaling. Matt, MES, I highly recommend everyone trade micros. They scale really well. Don't worry about the commissions. You can fix the commissions later when you go to minis. It's really flexible. There's not a big difference adding one micro, so it's not a big jump. But then you've got to practice with micros in Ninja. A few people showed me their prop trading accounts at Orlando, and one guy had like a couple of $1 million worth of accounts. And I was like, man, you're trading with a size that you're not going to be able to trade with real money for a long time. And so the training and the trading don't match. And so when you're under pressure and you're trying to increase your size, you're going to buckle. So yeah, and that's probably hard, because if you've got one of those funded accounts and you've got, I don't know, like 100 grand or 250 or whatever they offer, I would still trade micros and just get really good at it, because there's no difference between trading micros and minis. There's no difference between 1 contract, 10 contracts, 20 contracts to the price action. It matters not. But all of a sudden, when it comes to buying these really high probability buy signals, we know we're trading too big a size, because all of a sudden we're hesitating. Oh, might reverse. Oh, might reverse. Oh, now the stop's too big. Oh, maybe it's finished. And you're just giving yourself reasons never to take a trade. So if that's your mistake, your default is 1 micro. You get out if you get the consecutive opposite bars. So I told you, I've done a lot of these mistakes. And then you get better and you get new mistakes. Anticipating breakouts, yep, that's like this one here. You've missed a lot of this, so you close too early. You don't want to buy after that big bear bar. You wait for a couple of legs down. Bull bar near the moving average. This buy is only for a test at the high close, really. The breakout measured move is for up here. Yeah, fearing reversals. Do a lot of charts on second attempts. Yesterday was a classic. And once you get good at it, you can do the opposite, which is fade it. So you're long and you're like, okay, I'm ready to get out if the bears get a second attempt. And it was horrendously weak. Here, bear bar follow through, Second bear bar follow through, okay to exit, but only exit if you're willing to get long again, somewhere in there. And that's a motor skill. That's something you practice in market replay. You know, find an area of the chart. Like I practiced this one a lot on, I think it was the weekend, because this was such a good example of you have to switch. Is it always in long, nut, trapped? Second leg down, second leg down, but very deep pullback. If that gets one more bar to a new high, it's probably always in long. You know what I mean? This switched a lot of times. Trading it's a trend. Yeah, man, really, man, it's a tough one. So I think it's got a couple of layers which I would encourage you to look at. So one is you're waiting for probability. And this is common. I mean, you know, Trader Tom in Orlando put up a chart where he was buying a bear trend like all day, you know, scaling in, and you know, lost thousands. And he put the chart up, and he's like, I look at this before I trade in the morning, just to remind myself that I can be a good trader, but I can also be a bit of an idiot. And then Al and a couple of other presenters were just sharing the days where they were doing the wrong things. So everyone makes it. I would encourage you to work on always in, and then just one micro wide stop. And then just try and sit in it as long as you can. And you'll be surprised at how many reversals fail. Even here, 5 bear bars fail, new high. That's in a trend day. I think a lot of traders are good at a trading range, can't do a trend, or good at a trend, can't do a trading range. I would practice those days specifically. You know, get that on market replay and practice buying and selling different bars, seeing what happens. Some traders just buy and buy 10 points below. Sell 10 points above. Both of those strategies made money. Yeah, Alan's got a faster EMA. That's good too. For me, if I'm looking for reversals, I look at a faster chart. I look at a 2-minute chart, and then I'll wait for a bear breakout of a bear bar if I'm long, or a bull breakout of a bull bar if I'm short. So let's imagine you sell somewhere in here on the 5-minute chart. Until the bulls get a bull bar closing above another bull bar, I'm not out. I'm until there. On the way up, you're long until you get a bear bar closing below a bear bar. Bang, there you go. So you're out below that. See how it didn't go below it? Pick a rule that you can follow that's simple. Oh yeah, man, it's the worst. Undoing 30 days of work. It's like, yeah, man, it's I don't know what else to say to that. There's something to be said for acting in a way where you can keep playing the game, and it's really tough. You know, you take a bit of a loss as soon as you start the session. Okay, then you have another go. Okay, another loss, and then you're like, okay, this can be the good one now. I've got a third loss, and you know, sometimes it's like, you know what, I'll just come back later. Come back tomorrow. So we're hugging that 2-to-1 target on the daily. So I think the same logic might apply. Traders buying here are going to scale in 10 points below. Anyone selling here is going to sell 10 points higher. I just can't take a stop entry. The 9, I'm sure Alan can explain the 9 a bit further. For me, it makes sense using a faster moving average. But the principle is that the first attempt fails, right? Tight channel, first reversal is minor. But once traders see that first reversal, you can see they took profits when it came back up into it. It breaks a trend line. And that's a really good, I think that's a really good tip. You're long here, we break a trend line, but then we come back and test where it broke. But what you need to sell is break a trend line, test, and then another sell signal. That's what I use for my sell. So I can't take a reversal unless I see that. So you break a trend line, test. Is that a good reversal bar? Not really. Tight trading range, hugging the moving average. We're in the middle of this final flag. We're in some kind of a pullback on the 60-minute chart, but this is the most recent bit of price action, so I'm expecting the bears to get, 5-10 points or something. I don't think it's a good sell below this bar, so if it does get down there, I think you'll have bulls buying and scaling in lower. This was a lot of bull bars in a row, 1, 2, 3, 4, 5, 6, and so I think in terms of stats, 6 bars is the likelihood of a pullback rises. Yeah, this is great, guys. Share the mistakes, because it's it's about just practicing fixing those. If it's a quick fix, like just don't trade a certain time or a certain instrument. There are many trading softwares you can use. I'm not affiliated, or Brooks Trading Course isn't affiliated with any of them, but you really only need to use them once to put all your data in. It's going to tell you a whole bunch of information. Days you're profitable, times you're profitable, instruments. Do you make your money long, short, blah, 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 and then you just print it out, and then you're good to go. Now, the 20 is so reliable, I'm not surprised it doesn't use the 9. But if he wants to see something on a lower time frame, we'll just look at the 1 or 2 minute. Or 3 minute. So here's a 2 minute chart. Second entry long. First touch of the moving average in 40 or so bars. So it's the same on all time frame. Yeah, that's right. We use the 2 minute and the 10 EMA. That's right. Good memory. So if you're a bear, you're selling here for a 1-to-1, betting to get back to the 79 close. So the risk reward is not super. No, that's interesting. You see a pattern. I can hear Al in the back of my mind saying the opposite. I hear Al in my mind saying the things. Let's work through that. I think that's an interesting point. You've got consecutive bear bars below the moving average here. It's in a trading range and in a very tight trading range. So I still think the target's about 5 points. I'll change my mind if bulls on 1 can't scale in and make money. But I'm expecting them to buy the low and get back to that area. To me, a stop here doesn't make sense. JD, it was about 10 years, but off and on, trading shares, not like full time studying. Like a lot of people put a lot of hours, every day into doing that. I wasn't. I was kind of leisurely losing money. I guess I had a bit of a chip on my shoulder because I'm a chartered accountant, so I just thought that I could read P&L, balance sheet, cash flow, and trade. I thought fundamentals. Yeah. So I had to lose a lot of money just to prove that was nonsense, or to prove that I couldn't do it that way. But I think you could do it in 5 or less with, mentoring, instructions, picking one system, not doing 10 different courses. Yeah, leisurely losing a lot of money, still, my friends and family, they'll never know how much I spent to learn how to trade. We just wouldn't be able to comprehend it. And the speed of losing it as well, because I thought if I just kept like trading, then eventually I would learn it, but it's a different skill. It's a different skill. You know, if I was going to become an amateur painter, you know, like drawing on the chart, but it's not. I have to become a trader. So I can't just draw on charts. Accounting skills, no. I think they did not. You know, all I've got to decide here on 12, right? We're at the end of the first hour. It's an inside bar, which is not surprised because we've got a bull spike, bit of a bear surprise. Inside bar makes sense. What's my reason to be long? Well, I'm buying here in the bottom third of a trading range. That makes sense. Yeah. But I'm only buying here if I can scale in below a bull spike. High chance we're going to go above a bull bar and a bull trend. Reason to be short is, well, bulls have failed here. Another 3 bear bars. Will this just keep drifting down into the buy zone? And who's got the probability? Well, we're in a tight bull channel on the 15-minute chart, so scalping short's probably about a 5-minute trade, whereas you could probably hold long for an hour. So then all the accounting stuff's irrelevant. You know what I mean? Those 4 sentences, you can kind of like pick a trade and manage it. So bears want this to like trap bulls and then get a bear breakout, new low, measured move down, right? Very low probability. But also low probability for the bulls to do that. If we get up here with all these tails, people are going to buy or sell. Probably going to sell. That's what everyone's been doing all morning. Hi, and Gaines, are you on the stream? It'd be great if there was a little icon that said when people are on the stream. So 3 consecutive bull bars, 2 big and closing on their low. Looks like a second leg on the 15-minute chart. But I think there's only 5 points to it, and the stop's 10 points, which is about the opposite of what I want to be doing. So bears unable to get follow through on the 60-minute chart. If we just have a look at the ETH, oh, that's not going to make the decision easier, is it? We've got an 00 with a bull breakout. So, sorry, rise below somewhere there, but we already kind of knew. Makes sense. Your bear's not able to get follow through inside bar. So that means bear's more likely to sit up here, 559. I still think better to be long, but it's not going to be a quick trade. I got a few messages from people on Discord, which was great. They were asking about the work they were doing. It seems like everyone's doing a lot of live trading, which is great. I think it's better just to trade, you know, an hour or so, take some trades, so you've got some emotional content for the learning, and then, you know, you've got videos, webinars, and then the homework, and then use that to look at charts. But some people were like trading for, you know, 8 hours and then watching a video for an hour. We should be a bit of a mix. So what's happening on 13? Because it's the bottom third of a trading range, the buy there is 1-to-1. And what this is going to do is going to give the bulls a buy signal right up in the top of the range where they don't want it. From memory, there's actually another 2-to-1 target in the middle there, but I just didn't want to suddenly rise. Best choice, I think, is flat. What are some other mistakes and suggestions about how to fix them? Because you don't need to fix too many mistakes, you know what I mean? If you're trading a couple of hours, you take a long, you get stopped out, you look for a sell, profitable. You sell up here, you make money, that's okay. Maybe you take a second entry long, maybe you break even in here. Trading range and you're confused, you do nothing, you don't trade the session, you come back when it's a better day. Here, 4 or 5 bear bars, small pullback, looking for a low one, sell, scalp. Generally, you shouldn't take 2 mistakes in the same direction. Here, strong bull breakout, looking for a high one, decent bull bar closing on its high 9, scalp, you're done. You waited here to get long and you get consecutive bear bars, you need to get out, and you can see where everyone got out. If you sold there, you made money. So you take a loss and you flip. You get long somewhere in here, you get stopped out, you sell for a second leg down, you make it back. Here you sell, at some point you get stopped out. But if you bought anywhere in here, you didn't, so you could make it back. ES is very forgiving to, which is why Al says, you take a reasonable trade and you make a mistake, you can generally reverse in the same area and make it back. You're short, thinking it's going to go down, you 4 bull bars, well, at some point you need to get out and you need to get long. Or you did nothing, you look for the second entry sell, you got stopped out, you buy. I think we need another couple of bars on the 15-minute chart. What did I say? 2245 was around about pattern-wise when I thought this would play out. Let's just check. That was the breakout of the trading ranges there. Yeah, about 19 bars. If it's a half that, yeah, somewhere in the next 15, 20, 15, 30 minutes. That principle is just that the correction is usually about half the size of the pattern. That's really good for wedges, actually. Someone was so where's a wedge? So we're a bull trend. So if that's the wedge, and that's 45 bars, then if you're buying based on that pattern, then you're going to need 2 legs sideways stuff. So you need at least 10 bars, 2 legs, or half the size of that pattern, which puts you up in there, which will prevent you from buying and then scalping out and missing that second piece. Here's a better one. Here's a wedge. What's the pullback from there? 48 bars. there's 24. So that's going to keep, so when you see this spike, rather than panicking out like, oh, that's finished, it's probably got another hour to go. I mean, you probably make the same amount of profit anyway, but. So back above the moving average. We're still above the open. So we should get a 20-point swing at some point today. Because we're in a bull trend on all the time frames, I suspect it's going to be up. Which would be 55.75. 20 points down from here is also possible into that buy zone. So 15 becoming a bigger bear bar, trying to close below the close of the last hour. Bull inside bar, so probably bias below. If you like scalping in a trading range, you're looking to sell above bear bars, you're looking to buy below bull bars and scale in. So selling above a bear bar here. You've got to be able to handle the pullbacks. So you've got consecutive bull bars. So if this is a trend, then traders are going to sell below it. If it's a trading range, traders are going to buy below it and scale in lower. Let's see what happens. Bear's trying to close this gap. Consecutive bear bars on the 15-minute chart, but not able to close below. So bear bars on the 15-minute chart, but not able to close below. So bears want to switch this into always in short, break below 1, pull back, test, get a low 1 sell, get a measured move down. You generally don't get 3 bars or more than 3 bars in a row in a trading range. So if you're a bear, you sell a bear bar, you get 1 follow-through bar, then you need to be looking to exit. Looking like bear spike, pull back for a channel, 1, pause, 2, pause, 3. We'll see it as a wedge bull flag for more up. But it's so tight and horizontal, I think better just to trade it as a trading range until someone gets stuck. At the moment, no one's stuck. Haven't been back to the open, haven't been back to the low of 1. So no bulls here, had to scale in. Any bull bar you bought and bought 5 points lower, you made money. Any bear bar you sold, you didn't really even have to sell 5 points higher. So at the moment, the bears are actually stronger in this smaller range, under less stress. But I think down here is a buy zone. I'm hoping for a 15-minute signal bar. Because at the moment on the 15-minute chart, you can kind of still be short here. You know, say you took a second entry sell, ballsy, or you wait for the spike, pull back, and then sell at the entry point again. So you're short from there, and you're basically at 1-to-1 profit. But you need 2-to-1 if you're taking that sell, I think. Looks like the range is good for about 4 points, 49. 75% of a bar range is a good figure. You're just really looking for 1 bar in your direction. You see 10, you sell, you get 11, you're out. You see 12 in the bottom third, you buy, you want 1 bar, you get a big bar, you're out. So 16, small bar, it's in the right place for a buy. Right place for a buy. But you can only enter it if you okay it scaling in. Bears want to sell. They're going to argue we've got consecutive bear bars below the moving average. So bar 17, so after 18 bars, we're usually seeing the high or low of the day. This is a very small trading range at the moment, so I'll just move that to one side. We're going to break out of this range one way or another. Either we're going to measured move down to 35, or we're going to go up to 71 area. So traders that bought one, they buy one, they buy more below. That's their break-even point that I'm watching. Let's see what happens to them. For the bears to trap all the bulls here, they need to break strongly below one, get below the leg from yesterday, pull back and not let these bulls get out break even. So they need 17, 18 to be pretty aggressive. Bulls would really like a buy signal here at the moving average, I think, on the 15-minute chart. It's also pretty high on the 60-minute chart. So will that be for scalp maybe 1 times the 15-minute bar range? Still inside yesterday's range. That's 39. So another bear bar closing at the 16 low. So 4 bear bars down, good for bears, but tails on the lows. So 4 bear bars down, good for bears, but tails on the lows. Can they close far below 1? Can they close the bar on its low? Can they close this gap? This kind of endless pullback usually has a couple of characteristics. One is transition below the moving average and bull bars don't trigger. You see bull bars didn't go above it. Bull bar didn't go above it. Bull bar went above it and then immediately below it. So we're seeing a lack of stop entry bulls buying the close or buying above the high of a prior bull bar. So basically limit order bulls only. And then at some point there's a give up and a bear breakout and follow through. That was a wedge, 1, 2, 3. That was a chart. It's very similar. Wow. Exactly the same. Crazy. Transition below the moving average, trigger once, twice, went more sideways because it triggered, and then consecutive bear bars. Here went back to the low of that spike, consecutive bear bars, pull back, and then down. Transition below the moving average, many bars. Here was the wedge at the moving average, failed. So if you're long there, this is one of those examples of not scaling in, because if that's going to take off, the buy is going to be above something, but it fails. So you want to be flat. Even if you take a loss, you can look to sell the second leg down. Okay, so bears able to close the gap to yesterday's close. So good for bears, but still trading range. So can the bears force these 15-minute balls out, close below, pull back for another leg down? We've got a bear micro channel, but a lot of overlapping bars. Is this 3 legs? 1, 2, 3. Bears want to break out, pull back. Second leg down. Coming to the end of the hour on the ETH chart. So you might be saying, oh, look, it's 5 bear bars, we're below the moving average, it's very bearish. But on this ETH chart, a lot of overlapping bars and difficult to sell below on the 60-minute chart. 15-minute chart, we've got a moving average below. Okay, so 3 bear bars on the 15-minute chart. Good for bears, but tails in this gap. So we're back at the open of the day. So logical measured move for bears would be saying, okay, higher the range to the open and down, which would be 36. But I think a bad place to sell below anything. If you sold 11, you have to sell more higher to make money. If you sold 15, you've got 1 point profit so far. So 15-minute bulls, buying the close, buying below, their breakout point is about 51 around here. And we'll see if that leads to more bulls buying and higher or sideways for another leg down. The bull bought 1 and bought more below, that midpoint's 51. So I want to see if those bulls stay or go. So not a good sell signal on the hourly chart below that bar, but not a good buy signal above, 58.47. So far for bull bought 1 and bought more at the 1 low, they didn't get back to their breakout. Conflicting rules, series of large bear bars, closing gaps, moving average, but still not a good place to sell buys below. I don't understand the question. I mean, your rules are your rules for trading. I can't see a good sell for my style. Because for me, the stop's up here. So I'm taking a 4 to 5 point short trade with a 10 to 15 point stop. So outside bar 19, by closing on its low and closing below 1, can the bears keep price below the open and below the moving average? Yeah, thanks, BD. Should I stay or should I go? That's what I was channeling. So those 15-minute bears are still in, so they tighten there. You could argue they sold and got 2 to 1, so then that's an inside bar, not very good. So you sell the close there, your 1 to 1 is the same price, 42.75. So can they get their leg pull back, stronger second leg down? So first bull bar in 1, 2, 3, 4, 6 bars. So is that reversal minor? One more bear bar? We didn't quite test the 69 close. In all these bear bars, 15 closed below 14 and below the moving average. Didn't get a follow-through close. 17 not, 18 not. 19 is the first bear bar to close strongly below the prior bar and both under the moving average. Makes me think this will get one more bear bar at least. But even with all this bearishness, it's still only 2 points below the open. The bulls need to go above 20 to trigger a bull bar. Like we were looking at the endless pullbacks. I think it needs to be up above 12, 13, but if it's going to be up there, it may as well be up at the high of the day, 59. No. You can't put it here because that's where the moving average is, and we're likely to go there. Okay, point G, is bar 20 a high 1, high 2, or high 3? Okay, so we've got a bear breakout. We're going below the low of a prior bar, then we go above the high of a bar and below. So technically, we're in a low one here. But a lot of traders will look at dojis as the pause. For me, I'll look at, if we're going down, I'll wait for it to go above and then below again. So it's a low one sell below that outside bar here. For high ones on the open, we go up, we go below the low of a prior bar, and the high one's here. And the high one failed, which was a sign of a trading range. Failed, which was a sign of a trading range. So if low ones and low twos work, that's a sign of trending behavior. Weak buy signal 20. So still drifting down to the swing point here. So some traders will look at the inside bar. So breakout inside bar, high 1. I count it this way. We're going above bars, then we go below. So that's the high 1. We go below, and then that's the high 2. Above 17. Yeah, and outside bars make it confusing because it's both. So I would come up with your own way that makes sense to you. Either you've got to count both or count neither. For me, I'll just ignore it. So now 4 bear bars on the 15-minute chart. So does this need pull back 15 minutes and then another bear bar? Or are we going to strongly transition below the moving average here? Back 15 minutes and then another bear bar? Or are we going to strongly transition below the moving average here? You can see the clearest sell signal, 19, we got 45, 2 points below it. So bears were making money selling above things. Some transition to selling the close, but it's dangerous. Others waited for it to break below and then pull back and test underneath the moving average. 6 bear bars down. Bulls haven't done enough to reverse it yet. $14, 15 leg 1, 16 pause, 17, 18 pause, 19 is that 3 legs down and now breakout mode for either direction, or is this leg 1 pause for a larger leg down? This leg 1 pause for a larger leg down. I think you can be short, you've got a wide stop, but your risk reward's not great. I think you can be long as a limit order trader with a wide stop, buying and scaling in lower, and you should make money. But the risk reward's not great on either side. Bulls haven't reversed this yet, so even if 22 is a big bull bar, it's probably more likely to go sideways. Big bar, small bars, so expecting a big bar in either direction. I think 15 minutes says a bit more down. We're coming up to the close of the second hour, and we've gone below that inside bar, and we've started to go sideways. If bulls decide it's not a good place to buy here to scale in lower, then the next 20 points could be down. In order to break out of this range, I think the bulls need to create some kind of double bottom and it fail, or the bears to get a strong breakout and follow through to get the measured move. 15 is the only decent sell signal, and traders have just got 5 points after 7 bars. 48.50, not even. They needed one more tick to get 5 points. Oh, nice one, NMC, if you sell under 14. Yeah, bear inside bar above the moving average. So, I mean, it's a low probability sell, it works. So if you held for 10, brilliant. If I wasn't in the room, I usually sell breakout pullbacks. So 15 is a breakout, pull back to the breakout point. So I wouldn't have got filled there. Good bull bar scaling 1 times below. So you ignore the buy the close and then you buy 1 times below. So probably long there. 10, good bear bar closing at the moving average. Follow through, should get a second leg down. They get trapped. Thought 12, 13, probably needed a second leg. So bulls need that close above the open. If they don't get that, then I think the measured move is down here. From the high to the open down. Breakout, tight trading range. Breakout, tight trading range. This is going to be a trending trading range day. We usually have sideways, a breakout, and then sideways again. After 2 hours, this doesn't look like it's going to be a strong bull trend. It's yet to be proved that it's going to be a strong bear trend. Bears could get a low 2 here maybe and sell under 1. So last bar of the second hour, important for bulls. If you bought 1 and you scaled in, then you're not too worried about this sideways price action here. You bought in the middle of a trading range, so you're expecting it to go below things and pull back, or above things and pull back. And you're waiting for a strong change of character, I think. Bears want 24 to be a reasonable sell signal to convince bears to sell below 1. They're currently sitting in this gap. Thanks, DB. Cash made a lower low below yesterday, 79. Russell sideways, new high, bull flag, trying to break out. And the bulls get a close wedge bottom, measured move of the last leg, expanding triangle. Can the bears close below that inside bar at the end of the hour in a couple of minutes? Can the bulls close back at the open? This is an important magnet. We go below, we go above, and then we hold. Bears give up. Above, below, we oscillate until we break above, come back, can't close, and then market drifts up. Bulls tried twice back to the open, went down, ended up coming back to close. Bull breakout comes to test the open, finds buyers once, twice, new high. At the moment, I think traders are long and short. You've got limit order bulls buying and scaling in lower. You've got bears holding short positions, but they're not holding a lot of profit yet. So they're still below the moving average. There's no need for them to panic, but they're low in a trading range. They're hoping for this break below measured move down. So 60-minute bar, it's a bear doji, closing slightly below that inside bar. A very small bull inside bar on a 15-minute chart. So not the world's greatest buy signal above that. I'm going to think, looks like we're probably going to go below it. I thought with 4 bear bars, we'd probably get at least 1 more bear bar in here. 24, not a great sell signal. For myself, if I'm short 19, for example, because I'm expecting a breakout and follow through, I needed a breakout and follow through below 1, which I didn't get. But if you solve the close, that's okay. Decent bear bar below the moving average. 1, 2, 3, 4, 5 bars. I haven't made any money and I'm back at my entry. I usually get out and then assess what's happening. Because my expectation is I'm in a breakout and I want to get a second leg. And if it goes into breakout mode, then odds go back to 50-50. Which for me, generally, is kind of not good enough. Happy with 40, looking for a swing. I'm happy with 60 for a 1-to-1, but 50 is a bit more difficult. If you get like upset or frustrated in a tight trading range, then it's better just to come back later, come back on another day. This is a huge volatility expansion, moving to a new price zone. So you expect a bit of price compression. And you can see that on a 5-minute chart. You get a big bar, bull bar, sideways. Small bars, big bar, small bars. And it does this all day. So if you're looking at this stuff on a 5-minute chart, then you need to go up a time frame. And we need a Globex on that, so it can make sense. Huge bar up, small bars, sideways. Big bar, small. Small, big bar. So we're in this compression after a big spike. Can the bears keep price under the open? 25, 26 at good bear bars, then higher chance of getting down to that measured move. This range is not big enough for a whole day. So, because we're in a bull trend, my bias was at some point we're going to go above yesterday's high. Usually after a buy climax like this, I think Al was saying 50% odds of a bull swing at some point in the first couple of hours. And like Huyas just said, we've got a couple of hours sideways to down after a spike. Parabolic wedge, 1, 2, 3, couple legs sideways. What I don't like about the bear case is stopping right on the moving average here on the 15-minute chart. Because your risk is all the way up here. You've got no new low to move your stop. Can the bulls get a buy signal here? You've got many bars down. Do we go above, below, sideways? So if you're bear and you sell 19, this is a case where I wouldn't scale in because I'm in the low part of a trading range. So if you sell and you get stopped out, I think that's okay. Break out, pull back, you might get a second leg up. Or you honor the stop, and if you get another sell signal that's reasonable below the moving average, then you've got another chance. Yesterday, bulls, even if you bought the last bull bar in this spike, you know, so you buy here and you're like, oh no, 57. And then you've got a wide stop. So if this gets a follow through bear bar, I think you need to get out. Gets no follow through, come back up and test that high close. And so all those bulls are okay. Strong break of a trend line, test, and then sideways. Strong break of a trend line, test, and then sideways. Bulls back above the open, back above the moving average, and in the low third of this range. So we did not get 5 points below 1. So a bull can buy here, buy the low, didn't have to scale in again. Some bulls will just ignore the close in the middle of the range and just buy below. It looks like the bears are failing. What's the other line there? That's the swing high in this little leg, and that's the break-even point for bulls. Thanks, Stevie. Am I seeing too much in a 5-minute bull flag? No, I mean it's a bull flag on the higher time frame. Yeah, absolutely. Strong breakout and then pull back. We're going sideways on the 60-minute, sideways on the 15-minute, and that's the problem for bears here, is that if we're in a bull spike and we're pulling back, it's a low probability sell down here. And you can see where I had that green box, I dragged it across, and you can see it did not get filled, that low close from the bears. So if you had an order there, you would not have gotten in. And that's a problem for the short side. It was a problem here, they didn't get breakout and follow through. And then the outside bar was the best bar, no follow through. And now it looks like we're going to go above that outside bar. You notice in here, I never said buy the close, and here I never said sell the close, even though there's lots of bear bars. But to change the nature of a trading range, it's got to put pressure on someone's stops. And it didn't hit anyone's scale-ins. And that means everyone's in their small first position and they're chilling. And these kind of flags can form triangles where they just kind of keep narrowing the range and they don't run anyone's stops. Bought the close 17. Yeah, fading, buying the open in a bull trend, in a bull flag, I think is a good strategy. As long as you can scale in. Because we're in a high time frame bull environment, it's more likely we're going to run bear stops. So my targets would be above these bear bars. Or at least that's where my target is currently. So I bought in the gap here. Big bull bar, small gap up, bull trend. Betting that's an exit point for bears. And I was a little concerned on 19 because I thought, okay, well, if it gets follow through, I'll probably be able to get out back at that entry. True. I had orders to buy more down here, but they didn't get filled. So I'm going to get rid of that. So bull's back at the midpoint of 1. If bears are selling above bear bars, then that's a good bull target. And if bulls are buying below bull bars, that's a good short target. That's at least how I read a trading range. So you're long anywhere in here, and you exit at that bear target. Anywhere in here, and you exit at that bear target. Long somewhere in here, and you exit where bears would have their stops. Does that make sense? And it works the other way. Selling anywhere in here, and you want to run bull stops. And that's why we say you need to scale in where the stops are, because it's a really high probability target. Thanks, Rick. You beat me to it. Yeah, Jimmy, where's your stop? So we broke above the 19 high, which was the third leg down. We got back to the bull midpoint. And then I think we're going to race up to 555.50, which is where, you know, the top third in this sell zone was. But the same thing applies. Selling down here, buying here. You're buying in the middle of you're trading in the middle of a trading range. So you've got to be okay with it going sideways. Consecutive bull bars at the moving average on the 15-minute chart. So that's much better for bulls. So, you know, if I was a 15-minute bear, that would be a real problem. That would be a real problem. So they're probably hoping for a test down to the top of that inside bar. So we got the timing pretty bang on this morning. We said there's a parabolic wedge for about 19 bars, 19 or 20 bars, and then we needed to sit through about 10 bars worth of pullback. Bulls looking for the buy signal at the moving average, and so I was a bar off, but whatever, it's the right place for it to do so. Still a trading range, so it's less likely to just rock it up here, more likely to, you know, run skunk stops for the bears, run skunk stops for the bulls. So skunk stops for the bears, run skunk stops for the bulls. So if ATR is 4 or 5, you're probably better off taking 4 or 5. If this gets a follow-through bull bar, I'll change my view, because then we get a second leg up on the 15-minute. I had a catastrophic stop. I like the name. Okay, so what he's saying is this. I have a stop under 48. You're buying, was it 17? No. Yeah, close of 17. So 15, 16. You're buying the close of 17 here. So your one-to-one target is up here at 58. So if you're looking for 2-to-1, this is good. Appreciate your question. So you're buying here at the open. You've got a stop down here, which is the next swing point down. Okay, that makes sense. You're hiding it below 2 swing points, which is a common swing strategy, and you want 55.67. So my only real comment is, if a trader bought up here, I think you're more likely to get the high close or a couple of ticks off the high close, 560 area, yesterday's high. I think that's probably where we're going. But it's a good idea in a trading range. You know, you're going for 2-to-1, and you know you're going to take 1-to-1 or scalp out. And then if you get 2 to 1, then you immediately close. So that was probably the problem with this bear channel. You know, you sell, you get 2 to 1, you exit, and then where are your bear friends to keep trading? You sell 15, you get 1 to 1, pulls back. They took 1 to 1 or less and got out. 19 had to get out, there's no more bears left. So looking good for the bulls. So we're back at the 1 close. Sorry, not quite. Pullback timing method. Did I have a pullback timing method? Was that the depth of pullback or was that the pattern length? Or was that testable? Oh yes. So so the concept from the course is you find a chart where you can read more easily, and I think Al's guidance was you pick a chart where the moves are 3 to 4 bars long. So I think 15-minute chart would be the clearest. So, and that's why I was using the 15, because parabolic wedge, 1, pause, 2, pause, 3, sideways. So parabolic wedge, this is a breakout on a higher time frame. So we're expecting a second leg on this time frame after 2 legs sideways to down. So we measure the length. You know, I measured it from where we had a breakout close out of this trading range, but you know, it's an estimate. That gave me 19 bars. And then I said, okay, well then I need to wait at least 8 or so bars, which would be there, for the pullback to finish, expecting breakout mode and then a new direction. And when we got here, I said, well, now we've got 4 bars down, we really should get 1 more bar. Like, shouldn't this get a second leg? But we've got an inside bar, which is breakout mode. And now we've got a bull breakout. So odds are this pullback will have a second leg up, at least, you know, I guess at the moment, who knows, in the context of a trading range. Oh yeah, the fib time, yeah, nice. I was actually playing with that the other day. That's a good idea. It's basically just, you know, for the, I suppose some of the newer traders on the webinar, every pattern is part of the market structure. So you have a breakout, and then you pull back, and then you have a leg 2, then you have usually a 2-legged pullback, and then you have leg 3. And at that point, we're back in breakout mode. And I think the ability to recognize breakout mode is a really good skill. So here we've got a breakout, and we're pulling back. You know, a wedge pulling back to the 60-minute moving average in ES is usually a great buy zone, but you never got a buy signal. Then we get a buy signal in a bear spike, so it probably needs break a trend line and then lower low major trend reversal, and now we've got nested wedges. And that became the area of agreement that no one wanted to sell below, right? And if you can recognize when breakout mode happens, so we've got a wedge, couple legs sideways to up, this flag's ended, then when you get that new breakout, you won't need to hesitate. Because you can say, okay, well, I think that's my read, and if you're wrong, you're wrong. Yeah, Ed, I like your chart. The only thing is you've got to move that fib as the day goes on. You're going to get new highs and lows. So when you're in the buy zone, you're looking for a second decent bull bar, which was, you know, in hindsight, it was 25. But for me, I like to buy below bull bars in a trading range. But if I was short and then I see 2 good buy signals down there, like I need to get out. So then, you know, there's no need to rely on that stop. You can just get out. Matt, I wouldn't worry about the number of trades. I would just look at whether the trade's good. You know, there's all kinds of ways that traders use to kind of compare, like, okay, the range is 15 points. So usually if you can get between a quarter to a half of that range, then you're a good trader. Okay, so today that means 7 points. Me, I took 5. That was my goal. Buy below, scalp out, and then now I'm flat. But now we've got a better 15-minute pattern. This doesn't look great for the bulls because, you know, it could be a buy below. Yeah, I think ours says 25 to 40% or something like that. Maybe someone can confirm that. But I know a lot of other traders and particularly a lot of other presenters here who use the range as a guide. But you can often, in a trading range, if you're good at scaling in, you can actually make more points than that. You know, many more times the actual range. You know, scalping back to closes. You know, you buy the 15-minute bull bar, you buy more below, betting you'll get back to the close. Any of these sells, sell higher, back to the close, and that's another good way to do it. Yeah, I would keep that goal so you put less restrictions on what you need to do. Because even if you're clocking up, you know, 30, 40 points in a trading range, they're going to be on a smaller size anyway. So, you know, comparatively, it's probably going to be the same. So on a day like yesterday, which is a 70-point range, you know, 20, 30 points, that's well done. Scalping here, add on, hold. But at that point, my range was only 26, so that was about right. You know, 15 points in a 25-point range, happy days. Interested to hear anyone else's, you know, guidelines they use, other stuff they've heard. But yeah, that works for me. We went sideways with this magnet before for an hour. So I thought we'd get up here and test the high, but also you've got to be open to a fair bit of sideways. I made only the time looking at the chart for that range. Because I'm only trading, I'm trading part of the first half of the US session and the first half of the Euro session, sometimes less. You know, so if I made 1 point in a 27-point range, then, you know, yes, I've got a 100% hit rate, but I'm probably scalping for too small a target. You know, it doesn't make sense to scalp for 1 point when you've got, you know, 5 bull bars in a row, 6 bull bars in a row, and they're all 4 to 5 points tall. You're going to have a really high hit rate and lose money. And that's actually a really common issue. Your hit rate's too high. But I guarantee you exit, and then the move just keeps going for, you know, another leg, another 2 legs. Let's pick another day. See, range like this, that's a 20-point range, but these bars were pretty big. Yeah, so these bars are 7 or 8 points tall. So you only need 1 bar range in that whole trading range to hit that. And you should be waiting 5 minutes, I think. So consecutive outside bars at the target, but more likely to get a second leg up, basically into this empty space up here that everyone was selling. Bears are going to argue a couple of legs up. I think the bears had 3 little legs down, 2-legged pullback, and they wanted that low too short, good bear bar here, never got it. They got an inside bar, breakout mode, and then 3 good bull bars. So I think we're going to run the stops above 16. We haven't done a full day's range, so the bulls would like to do a measured move up, but I think more likely sideways here. Awesome. It's coming to the end of my session today, so think we've got Ironman Brad Wolf, who'll be joining on the webinar shortly. As always, absolute pleasure to be on the webinar. If you've got any questions, please feel free to shoot them through. Not an easy range to trade. You know, it's difficult to do nothing for a long time. You know, it was difficult to do nothing with all these bear bars. It looked like very clear we were going down here. But that's why I introduced limit order trades at the start of the session, because when you have a big day like this, it's very likely you have some kind of an inside day or doji. And that means generally the buys below bull bars works and the sells, so buys below bull bars work and the sells above bear bars work. So, yeah, Brad's the Iron Man because he'll do the whole day. He does, I think Rose as well. So she's Iron Woman as well. So, thanks everyone, and I'll catch you next time. Happy trading and see you soon.
I am long, taking a chance that we get up to the high of the day. I am long, taking a chance that we get up to the high of the day. I'm curious for those, can everyone see my mouse, or do you just see the screen? Can everyone see my mouse, or do you just see the screen? Okay, great. Mouse, you can see the mouse. Perfect. The mouse should be green to make it a little easier to see. Mouse, you can see the mouse. Perfect. The mouse should be green to make it a little easier to see. So trading range day overall, high of the day, high of yesterday, probably going to get there. Daily chart, we've had a strong rally. Let me just remove all of this. We've had a strong rally ever since the May 31st low right here. There's the May 31st low. And this looks like, I think this will be a bull leg in a trading range, even though it is the bears. So why do I say it'll be a bull leg in a trading range? Because I think we're overbought on the daily chart. And it might take months for this whole thing for us to get down here. But I do think we're going to sell off to the back to the May 31st low. We have a buy climax here, and we've had consecutive buy climaxes all the way up. So the odds favored any one of these sells is a low probability sell, and therefore the odds favor higher prices. But at some point, we get more and more climactic, and that will increase the probability that the market is going to have to pull back. So we have a really big bull bar. We have a bull bar here with a big tail, and that makes me question what's going to happen here. I think we will trigger the buy above the daily chart. And right now, on the 5-minute, we have decent follow-through buying, but the follow-through could certainly be stronger. So here's the 15-minute chart. And good bull bars here and here, but this current bar, I think something's going to be disappointing with this current price level. So at the moment, it's always in long, but I think we're going to see something disappointing. It's easy to be hopeful that we're going to get a bull trend day. However, odds are against it. I do think we'll get above the blue line. So as far as selling right here, I'm really not interested in selling. I'm more interested in seeing what the rally to yesterday's high, this blue line, looks like. So here's yesterday's high. I think we'll probably get up there, even if we pull back first. Everyone's saying the mouse is black and white, so let me try something really quick. I'm going to turn the screen off and just reload trade station. Just reload trade station. No surprise, we're pulling back, but probably buyers below. I think the bulls want to see a test of yesterday's high. Buyers below. I think the bulls want to see a test of yesterday's high. The bears want to prevent yesterday's high from triggering. So probably buyers below the 32 low, scaling in lower. Hopefully you can see the green mouse now. Bears causing disappointment for the bulls near the top of the trading range, 15-minute chart. Bull bars, but tight trading range. And you can see, as soon as we rallied, traders started selling. Can you sell below 33? I would not. The channel up is a little bit tight, and there's probably buyers somewhere below the 33 low. Bear bar closing on its low. Good for the bears, and a little bit of a surprise, so we may get a small second leg down. But I think the bears selling below 33 are going to be disappointed. And therefore, there's probably buyers below. The bears, they want this to be a failed breakout of the 13 high and we're going to call it a double top, failed breakout of the 13 high. They want to break below 21 and a measure move down. But probably buyers below 33. Now 34, if it's a bull bar closing on its high, that'd be a high one buy. However, there'd probably be sellers above it, and we'd get at least a small second leg below the 33 low or the 34 low. But the rally up is tight enough that I suspect we'll probably have to test the high of 32 at a minimum. Problem with 33 is risk reward for the bears. If you're selling below 33, you're selling high in the trading range. I say that, you're selling close to the middle of the trading range. And if you sell below 33 and you put your stop at the high, 1 times your risk is near the bottom third of this range. Higher probability to wait and see what the bears can get. Wait for a bear breakout and then a pullback. Otherwise, probably buyers below. But we could easily get a couple of legs sideways to down. It's not unreasonable for the bulls to get out below 33, although I think the odds are low that we plunge to the downside. Bears, they basically want basically a parabolic wedge, 24, the 29 high, and then 32. The 29 high, and then 32. This is a problem for the bulls, though. It's a reminder that we're in an overall trading range. By the time the market looks bullish, it pulls back. By the time the market looks bearish, it reverses. Consecutive bull bars, problem for the bulls. 33 and 34 is strong enough that we'll probably get a second leg to the downside. But as far as selling 34, it's a little bit challenging as well. In general, by the time let me say it a different way. Selling below 34 is selling close to the middle of the range. And usually, and it's common for the market to get a deep pullback. So it's possible we go sideways here, get a small second leg down, and then test all the way back up here. And that's the concern for the bears. But the bulls, they have a problem. Consecutive bear bars 33, 34, they may get a small second leg down. And it's possible that we just get another bear bar, 35 closing on its low, and then 36 closing on its low. I think the odds are against it. We'll probably go sideways and pull back. But this is not what you want to see if you're a bull. Are we always in short? It's tough to say. I think 33 and 34 is a minor reversal, and it'll get a second leg down. But minor, the problem with selling here is how deep is the pullback going to be? But minor, the problem with selling here is how deep is the pullback going to be? It's possible this is just a double bottom below 30. Low of 30, 50, 75. 50, 75 is this low. So we made an equal low with the 30 low. Bulls trying to get a reversal up. What about selling above 35 if it closes on its high? What about buying above 35 if it closes on its high? I think that'll be tough as well. Probably sellers above the 35 high. And I think that will reduce the number of traders buying above 35. Euro versus the dollar. 2 legs up. We had a bull breakout here, but lots of selling pressure. So basically, you can call it a test of the midpoint, test of this bar right here. Anyways, it's possible this is a second leg trap, and therefore the risk is we get a second leg down. Daily chart, bad follow through, but unlikely to go straight up. We'll probably end up going sideways here, but certainly a problem for the bears. The bears hit a decent bear bar here below June 13th, and then they got disappointing follow through on the 14th, the 14th and then the 17th. So we're probably going to bounce. This is what I was talking about. I don't think a lot of traders are interested in selling the close of 34. But you may have disappointed bulls who are long 30, 31, during 30, 31, 32, and they'll probably use a bounce to exit. Some bulls bought the close of 33 at 53 even, and the high of this current bar is 52.75. So the market came within 1 tick of the close of 33, pulled back. I'm going to turn off. If you have any questions, ask them in the GoToWebinar question box. I often don't have Discord pulled up, therefore it's easier for me to find them if you ask it in GoToWebinar. There should be a question box somewhere in the menu. We spend a lot of time in this trading range, bars 2 through 14. So this is an area of agreement. Bull bar 35. Are there more buyers or sellers above? There's probably sellers above, but my concern is where's the bottom of the range? It's possible the bottom of the range is the 30 low, and if you're selling above 35, you might be selling at the bottom of the range. I still think we're going to try and get above yesterday's high. So bears, 33, 34, they want a second leg down. Bulls want an endless pullback. They want a bull bar on 36, bull bar 37, and they want to prevent the bears from getting their second leg, thus trapping bears selling above 35, hoping for the second leg down. Second leg down. But how much lower are we going to go? It's possible 36 is the end of the second leg, and then we reverse up on 37 or 36. Again, odds after 33 and 34, the odds were the first reversal up would fail, and we would get a second leg down. and it's possible the second leg was 1 bar. So what's going on here? I think the market is deciding if we're going to get another leg up above 32 and test up to yesterday's high, which right now I think is reasonable. It's possible the sell-off to 36 is just a deep pullback from the rally, 21 low, 32 high, and we get a second leg. I don't think the bears have done enough yet. But the bulls are certainly disappointed. Reasonable for bulls to be flat here and waiting. I think a lot of so what did always in traders do? I think a lot of them probably got out on 33 or above 35. And they'll probably look to buy again above a bull bar. Really not what you want to see if you're a bull. But tough to be selling right here. See if you're a bull. But tough to be selling right here. We're right around 50% pullback from the low of 21, high of 32. Disappointment, not good for the bulls. Strong bear bar on the 15-minute chart, probably going to get a second leg. But let's see what 37 looks like. 37 might be bad follow through. Bears obviously want to undo this and get a strong reversal down. Why am I hesitant to say we're bearish right here? Because now it looks like we're always in short. And whenever the market becomes always in short, or looks like it's always in short, you've got to be prepared for a deep pullback. So I'd like to see more before I say it's clearly always in short. Trading range is always trying to get you to do the wrong thing. Sell right at the bottom of the pullback, buy right at the top. This could still just be a deep pullback, and that leads to a test all the way up here. But this is certainly a problem for the bulls. The bulls shouldn't have allowed the sell-off down to 36. So I think 37 is probably going to disappoint the bears. It'll probably be a weak bear bar or a bull bar. Obviously, the bears are hopeful 37 is a bear bar closing on its low. This is my concern. 2 legs down in a trading range. It's not quite a micro channel. And the channel, the sell-off down to 37 is tight, but this could lead to a deep pullback. So selling the close at 36, stop above 32, the risk is big and the risk reward is bad. You're short. If you're short, stop somewhere above the 32 high. 1 times your risk is basically the low of the day. And I'm not quite confident that we're going to get back, that we're going to go straight down before we pull back. So my concern here for the bears is that there's a lot of bulls buying here, putting a stop some distance down, betting that we bounce. See what happened? 24 high, where bears got trapped. We tested down to the breakout point here. So bull bar 37, probably sellers above and sideways. However, I suspect there's buyers not far below. Maybe buyers below 38, buyers below the 37 low, and we're probably going to pull back. Bears who sold the high right here of this bar on the 15-minute chart, 1030, which is the equivalent of the 24 high, and scaled in higher, basically made money. So what do I think is going to happen for the bulls? I think the bulls who bought the low of 11.15. These are Central Time. 11.15, 52.75. 52.75 right here. I suspect the bulls who bought the 33 low and more lower, and if they didn't get out above 35, I suspect we're going back to the 33 low, and we're going to allow them out with a profit. $38 low one short, so probably buyers below. Bad low one. Whenever you get a low one at the bottom of the range, usually there's more buyers below it. Same thing with high ones at the top of the range. So this is what I was talking about. By the time, the point I was trying to make about the sell is the sell is above a bar like 35, and you really have to be quick to make a decision. Because if you sell below 35, like on 36, there's added risk that the market reverses. Someone asked in the chat, if you trade in an always-in swing fashion, how do you exit or take profits? And, it's always funny to me. Whenever I was trading, so I'd ask Al all the time, every day in the trading room, I would always copy and paste, Al, can you talk about the day from an always-in perspective? And my thought with always in was you basically trade with stop entries the whole way. You buy above here, you sell, you buy, you sell. And I thought always in the literal sense, was you have to be in the market long or short on every bar. And then what I come to basically accept and learn is that's not exactly, that is always in, but it's not at the same time. When the market looks like this, it's not a good swing trading market. You have traders entering with limit orders. But overall, always in traders, if they buy above 1, they probably get out break even somewhere in here. If they sell below 4, they probably get out either as 12 starts to reverse up, because it's basically an expanding triangle or a wedge down here. If they are long, they probably get out below 14 or during 15. If they're short on 15, they get out above 23. If they're long in here, they get out below 33. And then what are they doing here? I think we're probably going to pull back, but really tough to be long here. I think it's credible for the bears who sold below 33, though, to buy back shorts above 37. It's 2 legs down in a trading range. I tried those on mute. I'm not sure if anyone heard the always in discussion I just mentioned, but someone asked about if you were trading always in long or always in short, how would you trade it? And this is not a good always in day. Bulls, and the reason is, by the time it's clearly bullish, it usually fails, and by the time it's clearly bearish, it usually goes the opposite way. Someone said that, yes, they heard the always in discussion. So the point is, this is too tight of a trading range. Bears, they want a second leg down from the sell-off, 32 high, 37 low. Bulls, they want to bounce and a test up to the 34 high. Not a good sell below 39, so probably buyers below it. $39 is a stop entry sell, but forcing traders to sell within a tight trading range lasting 4 or 5 bars and 2 legs down. So it's really not all that ideal. Bears, they want a second leg down and a breakout below the 37 low. We're close to the open of the day, so we may have to get there. Here's the open. So close to it that it's possible this was just a pullback and we'll test the open here. but tough to sell right here, selling near support, and we could easily bounce all the way up to the 32 close. The dominant feature has been this tight trading range, and therefore it's best to assume that while everybody knows we're going to break out, we're basically in a triangle here and here. Everybody knows the market's going to break out, but it's important to remember that it could take a really long time before it actually happens. So there's the triangle. You could argue it's contracting and it's getting squeezed. Maybe this is the triangle. Didn't really matter. Point is, the market's deciding, are we going to break to the downside or break to the upside? The key in here is to be patient. Betting on a breakout up or down, the probability is really close to 50-50. So no matter how certain you think that you are, that the market's going to test yesterday's high, or that the market's going to break to the downside, the most important thing to realize is no matter how certain you are, you're near 50-50. You can see buyers below 39, bulls trying to get the upside breakout. If you're a bear and you sold the close at 36, how long are you going to stay short? Are you going to keep your stop? Are you going to stay short if you sold the close at 36 and keep a stop above 32? Or are you going to get out above a bull bar? I think it's credible for traders to get out above a bull bar. Bulls, they have a chance to get a reversal here, but they need buying pressure. Why is it credible to get out above a bull bar? Because if you're a bear, your risk reward's bad, and if the probability starts to go sideways, that means the probability gets neutral. And if your risk reward is bad, in other words, you have a 1-to-1 risk reward, and your probability is close to 50%, that is a losing trader's equation. Disappointment for the bears. I think it's reasonable for bears to get out above 43. It's a tight trading range, but we may end up testing the high of 32. And the bulls, they want to break out above the 32 high. So what the bulls want is they see a bear flag, 37 to 41. They want a bull breakout of the bear flag here, and then a measure move up to around 55, 58. Ultimately, the bulls want to break out and measure move up to yesterday's high. Whenever I'm looking at the market, I'm always putting myself in the shoes of both the bulls and the bears. So I'm always asking myself, if I'm a bull, how am I feeling about the market? And if I'm a bear, how am I feeling about the market? So if I'm a bull and I was long 30, 31, 32, and then I held through this pullback, my one question is, I want to see how strong this rally is. Because I'm disappointed by the sell-off, and if I'm disappointed, one logical thing to do is get out break even at my first entry with a profit on my scale-ins. Here, I think there's at least 50-50 chance we break out and test yesterday's high. So I might be willing to hold here. The bears, I think the bears are giving up here. They're concluding that 36 is a trap and that we're not going to get a large second leg. This is a great example of the dangers of selling in the bottom third of the trading range. The sell was below 33 or during 34 if you could manage the trade the right way. Manage the trade the right way means you exit after a second leg down. And the risk, that trade is fairly difficult. A lot of traders selling above 35, they use a fairly tight stop. And it's a scalp, and it's a pretty aggressive scalp. So what are traders paying attention here? What I'm paying attention to is the structure of this bar. I want to see what the breakout, how it looks. I often show this slide pretty regularly. This is what I want to see. Bull bars without overlap. It's backwards, but that's what I want to see for the bulls. This is a 1 minute chart. Bull bar after bull bar after bull bar. And, well, in this case, they're bear bars, but pretend they were bull bars. The bodies are getting bigger, which means more and more traders are getting trapped. And that's what I want to see here. I want to see bodies getting bigger. These bodies are getting smaller, but they're consecutive. Look at a 2 minute chart. Bull bars, but tail, doji, big bull bar, disappointment. That makes me think we're going to go more sideways here. And my number one concern is, how's this bar going to close? So the problem I have here at this current second is 42 is a good bar, but it's becoming climactic. It'd be best for the bulls if 42 closes on its high, and then 43 is an equally strong bar. And it's not ideal if 42 pulls back into the close, which the close is in about 10 seconds. So disappointment. That's what I was talking about on the 1 minute chart. These tails, we're going to say the 2 minute chart, bull bar, tail, doji, big bull bar, bad follow through. That's a warning that it's a bull leg in what will become a trading range. We still may go a little bit higher, but there's not a lot of urgency for the bulls, and that is disappointing. You see what's happening here? Bulls who, in theory, bought the low of 32 at 55 even. The high of 42 is 55.5, and they're disappointed. The bull should not have allowed this. It's fairly disappointing. Market's deciding, are we going to test yesterday's high, or is this going to lead to a lower high or a double top of 32 and a leg down? So far, disappointing for the bulls. I think a lot of bulls are giving up here, concluding that we're going to go more sideways. Middle of the tight trading range, probability not ideal for either the bulls or the bears. Disappointment bar for the bulls increases the chances that the market's going to go more sideways. Breakout mode, probability not all that clear for either the bulls or the bears. Probably buyers below 43, but higher probability to wait and see what the breakout looks like. The odds slightly favor the bulls, not by much. Therefore, I think we're probably going to try and get up to yesterday's high. But the bulls, they need a strong upside breakout. I'm not sure if I was on mute, but I was saying, I think we're going to try and get up to yesterday's high. But the bulls, they need a strong upside breakout. So far, they're getting it on the 1 minute chart. We have a strong reversal without a lot of a pullback. But the bulls need to see more. We have a decent buy signal bar, 46, will probably trigger the buy signal. But the bulls, they really need a strong entry bar. Big bars in the middle of the tight trading range are low probability stop entries. They're breakout mode. The bears are trying to prevent 44 from triggering. Bulls, obviously, they want 44 to trigger and 45 to be a strong entry bar. You have a lot of bears selling right here, 1 or 2 ticks below the 44 high, trying to prevent 44 from triggering, and they want a reversal down. It's a swing buy above 44, a low probability, but the probability is close to 50-50, and it may slightly favor the bulls, but not by much. So you'll have some bulls buying above it. If I was buying above 45, I would trade small and look to add on if the breakout becomes stronger. Tight trading range, 45 and inside bar. Probability is still close to 50-50. I think it's on a swing. It's a swing buy above 45 or 44. Maybe stop below 44, taking a chance that we rally to yesterday's high and break above it. Bears, they want the triangle to get a failed breakout above the 44 high and lead to a reversal down. I think the always in bears probably get out. For one, I don't think there is a credible swing short yet. And then for the bulls, they can buy above 44. Just because the bears don't have a credible swing short yet does not mean that the stop entry above 44 is going to be successful. We might reverse down on 46 and create a stop entry short. But the bulls that are long, they probably have a stop below 44, betting on a bull breakout of the triangle. Breakout not as strong as it could be, and that increases the risk that we end up going more sideways here. It'd been better if 47 was a bull bar closing on its high. This is disappointing. Possible wedge, 39, 42, 47. So we may go more sideways here. You have some bulls getting out, concluding that we're not going to get to yesterday's high. We still might, but when you're long and you're near the top of the trading range, there's added risk that you're buying at the top of the trading range, you're buying high. And because of that, traders want things to be perfect. And when they're not perfect, they start bailing out of the trade or reducing their position. Not yet clear if we're going to reverse down. We still may go up here, but we don't have a lot of energy. And that reduces the number of traders willing to be long up here. In this kind of a market, I'm hesitant to hold positions. Too much risk that they reverse. Inside bar 48 is basically a high one, breakout pullback buy. Tight pull channel from the 37 low, but overall a leg in a trading range. And that will reduce the number of traders buying up here. Bears aren't really making money below bars, so it makes it difficult for bears to sell. At a minimum, the bears need bear bars closing on their lows. But getting vacuumed up to the yesterday's high, which is 61 even. Probably going to get there. Bulls obviously want to prevent it. Disappointing close. Bad stop entry sell below 50, bar 50. But we're so close to yesterday's high that we'll probably have to go a little bit higher. Makes it very difficult for the bulls though. This whole thing looks like a leg in a trading range, and because of that, you have a lot of bulls hesitant to buy up here. You also have a lot of bears hesitant to sell, and I assume because they'd rather sell closer to yesterday's high. But at the moment, this looks like a bull leg in what will become an overall trading range. Looks like we're going up to the yesterday's high. So probably going to at least go to 55.61. Tight bull channel, but lots of overlapping bars. And this could just be a buy vacuum test of yesterday's high. So while it looks bullish at the moment, and it is bullish, I would like to see more selling pressure. I'd like to see more buying pressure than what we have right here. Every time we rally, pull back, rally, pull back, rally again, pull back. Odds are whatever rally we get here will be disappointing as well. But we have the magnet of yesterday's high not far above. Bulls, they want a leg 1 equals leg 2. Not much more room left in that either. 61 even is the high of yesterday. And I think the odds are we're probably at least going to go to 61 and a quarter and go one tick above yesterday's high. At the target, bulls are hopeful that we break above yesterday's high. Bears want to prevent it. I suspect bad follow through on this bar. It will probably be sideways in here. I think always in bulls, get out below 53. Too much risk that we get a reversal down. Side pulled channel lowers the probability for the bears. It's possible we get back down to the open of the day and even lower. So far, reversing down, good for the bears. Decent entry bar. The bigger this bar is and the more it closes on its low, the greater the probability that we're going to go lower. The Bears have a chance to have this day close below the open of the day. The daily chart, we're climactic, and that increases the odds that today is going to get bad follow through. And therefore, think about it, that means we might end up selling off to a new low of the day. That would create somewhat of an expanding triangle on the day. So I think it's certainly possible. I think we'll probably try and get back to the open, and we may end up trying to fall below the 21 low, which is at 43.5. Always in short here, I would not be long. Odds are we're going to get a couple of legs sideways to down. Okay, let's see what kind of sell-off we get. Remember what I said. This day, today, is probably going to try and be a bear day, which means it's probably going to close below the open. We went above yesterday's high, and nobody wanted to buy it. This rally looks like it was a buy vacuum, and I mentioned that was my concern for the bulls. So the bigger these bars get, the greater the probability that we're going to fall below the open and the 21 low. We don't have to stop at the 21 low. I think it's low probability that this becomes a really big bear trend day. But if it does, there's still time. So let's see what we get here. I did sell below 53, taking a chance that we would at least get to the open and the low of the day. So far, looking good. Big enough bar, big enough surprise. Odds are we're going to get a second leg. These can be really frustrating. You look at these kind of sell-offs and you think, how in the world can this happen? That's so unfair. But what you have to learn is most rallies are buy and sell vacuums. And therefore, when you see the market rally like it is here, it may just be trying to find, it might be more, let me say it a different way. And by the way, I think it's okay to take partial profits here if you're short, or take partial profits at the 21 low. Point I'm making is this. When the market's forming a tight bull channel, it's easy to think that the bulls are owning the market. And it's true, the bulls are owning the market. But what you have to realize with that as well is that not only it might be more due to bears not willing to sell. When the market's going up, you never know how many traders are just waiting on the sidelines to sell, how many institutional bears have their finger on the trigger or the button waiting to hit sell, or have limit orders nested above. So back at the open, and we're starting to hesitate. No surprise. I think we'll probably try and go at least a little bit lower. And get down to the 21 low. What are the chances that we've seen the high of the day? I think the odds are we have seen the high of the day. This is enough selling to make me conclude that we're probably not going to give above the 55 high for the rest of the day. Big tail below the bar, so that is disappointing. And that's a reminder that we're in a trading range. Bulls, they're hopeful that they can get a rally all the way back to yesterday's high. But I think this is probably going to be a trading range at best for the bulls. So I suspect we'll form a lower high, even if we get above the 55 high. So the upside is probably limited. So do you buy the reversal? I think we're probably going to get a second leg down. And therefore, we're probably, at best for the bulls, going to be sideways here. Bulls, they want to cause as much damage as possible. The bears that sold below 54, 53, a lot of those bears used the sell-off to take profits. So 55, as big as it was and as strong as it was a sell vacuum test of the open. I still think we're probably going to try and test down to the 55 low at a minimum. The bears, they want to create as big of a tail as possible above this bar. And the bulls want the bar to close on its high. Well, the bulls have done a good job here. The odds are we're going to have to go sideways. So it makes it really difficult for the bulls to be buying up here. We could easily pull back 50% and retest the close of 55. Bulls, they want this bar to close on its high. And they want to get an endless rally back to the high of 53. But I think the bulls need to do more here. Probably buyers below 57 and at least a small second leg up. But we still may test down at the open of the day. So we may get a small two-legged pullback and then a test down to the open. Bulls, they want a breakout above 57 and a test all the way up to the high close. Trading range, most likely. You can see traders who bought the close of 55, disappointed, closed the bar 51.25, low of this bar 51.25. So we're probably going to bounce. We may have to test near the high of 57 by the closed bulls. On some time frame, 57 is a bull bar closing on its high. So some bulls bought up here, bought more lower. And I suspect they'll be able to get out without a loss. Bears, they want a downside breakout below 55. But we're probably in a trading range here. So I suspect disappointment on any test of the 55 low. So probably buyers below scaling in lower. But after 3 consecutive bear bars, the upside is probably limited as well. Bulls who bought above 56 and more below 56 probably will make money. Outside up 60, but a trading range most likely. Probably bears selling above 60, scaling in higher. We could pull back all the way to the 55 low. So as far as selling the 60 high, I don't know how great of an idea that is. Probably going to go sideways here. The bears, they're hopeful they'll get a second leg down from the sell-off 55 high, 53 high to the 55 low. But we could pull back all the way to the 53 low, the start of the sell-off. Bulls, they want to break above 60. They see 60 as a rally, 61 as a pullback, and then the 61 high as a retest. So they want to see a close above 60 at a minimum. They'd like 61 to close far above 60 and close on its high. It's easy to get upset by this. This is the day you have. And the reality is, the bulls, they're probably going to be disappointed somewhere up here, just like the bears were disappointed on the sell-off. So my expectation, again, I think the single most important feature of today is the 7-bar tight trading range. We have had a hard time all day escaping it. We go below it, we test back into it, we poke below it, get back into it, we break above it, test back to it. So we're probably going to be sideways for most of the day. We still may test down back to the open of the day to relieve the bears who sold and scaled in. But overall, a trading range is much more likely than the start of a trend up or down. Tight trading range, breakout mode, markets deciding on getting a reversal up or getting a second leg down from the sell-off to 55. Not a good sell signal bar below 63. But overall, breakout mode. Still nothing to do here. Tight trading range. So most traders better off being flat. We may get a second leg down, but higher probability to wait and see a strong bear breakout. And even then, it might be too late to sell it. So really difficult to be selling here. We may try and get a second leg down and fall below 55. Bulls tried to get the upside breakout and they failed. Now the bears will try and get a downside breakout. So we may try and test down to the 55 low. Bears, they really want to see follow through. Bears are hopeful it's a failed breakout of the triangle. Not really a great shape though, more of a tight trading range. And they want a second leg down. Bulls, they want a double bottom and reversal up. I think we're probably going to go a little bit lower and test down to the 55 low. Follow through selling after 65 or 67 with bar 68, but a doji. So the bears, they really need more follow through. Probably buyers near the open of the day and near the 55 low. Lower probability we break strongly to the downside. Bears are hopeful that the sell-off down to the 65 low is strong enough that it'll get a second leg down. And that is the risk that the bulls face here. We may have to fall below the 55 low and test the red line, the low of the day. Not a lot of bears eager to stay short with the tail on 68 at the bottom of the trading range. Increase the chances we're going to go sideways. Bears that were short, I'd get out above 69. Not a good tail. Any one of these stop entries can lead to a swing, but I think most traders are better off being flat here. It's easy to reverse back and forth and get chewed up, so most traders are better off waiting. reversal's looking good, but how will it look by the end of the close? And by the end of the close, I mean the close of this bar. Bulls trying to get a rally all the way back to the close of 52. And they might get it, but right now we're within a tight trading range. Remember what I said? We're inside of the tight trading range that began at bar 3 or really bar 2. And we may stay there for the rest of the day. Not much to do here. As far as buying, I think it's pretty tough. The buy was earlier around bar 69 as it was reversing up. And this is more of a sell zone. So overall, we're probably going to be sideways. What I was talking about earlier was this. Here is the tight trading range, and this is where we are. And we may stay within this range for the rest of the day. Bulls trying to get a breakout and test the high close. Are we always in long? Yeah, I think we're barely always in long. Problem for the bulls is you're getting right where bears got trapped, the high of 53. So really not an ideal environment for the bulls. There might be more sellers at the red line than buyers. It's easy to become hopeful, but being hopeful that the market's going to form a bull trend or a bear trend is the worst thing you can do on a day like today. For me, I kind of think of it as this is the day you're going to get, and I would keep this here. In fact, I may. I'll just adjust. I'll try and make it more transparent. This is, let's do this. We've been in a tight trading range for so many bars today. While this might rally and form a strong trend, the odds are against it. And really, there's not enough time left. So it's possible we get the upside breakout, but look up here. So the low of 53 is 58.5, and the high of 75 is 58.5. Do you think it's coincidental that the bar that trapped a lot of bulls raced down, and then this rally here, bar 75, stopped exactly at the low of 53? Of course not. Always in bulls that are long, I think they probably get out below 75. 75 is getting late in this session. And because of that, 75, let me back up. Bar 75, always in bulls, exit below. Bar 72 is typically my cutoff for trading. I really don't like to take trades much after 72. I occasionally will, but I try to limit the trades. And I really want the trades to be quick. Most traders should just be flat at this point. Wait for tomorrow. The odds are, while we may, it's possible we get some sort of surprise second leg down, I think the odds are really against it. So I think most traders are better just waiting for tomorrow. It's possible we get a surprise breakout and a test of the 55 low in the final minutes of the day. Low probability, but it is not all that uncommon. It happens enough times. You get some sort of surprise, and the market waits until the end of the session before you get the second leg. More likely, we're just going to go sideways in here. Remember what I said about the daily chart? The bulls are hopeful that today is going to be a bull bar. They've tried several times to get today to close above yesterday's high, and doesn't look like we're going to get there. So now I think the battle is going to be over the open. Bulls, they want today to close above the open so they can claim that today's a bull bar. The bears want the opposite. The bears want today to close below the open. That way they can claim that today is a bear trend bar. So open of the day is 47.75, and we may get a sell vacuum down to it. But if we are, it needs to happen pretty quick here. It'd be better for the bears if this bar gets bigger in the final seconds of the bar and closes on its low. That would indicate urgency. So let's see how this bar closes. Looking good for the bears. Bar's getting bigger. Bulls trying to prevent the bears from getting follow through. But after consecutive bear bars, 74, 75, 76, we may get a small second leg down. But the bulls are certainly doing a good job trying to prevent it. Disappointing for the bears. More traders buying the low of 76 than selling it. I said that we may test the open of the day. It's possible that we do the opposite and get all the way up to yesterday's high. The bears should not have allowed 77 to happen. Looks like we're going to test up to the 52 close. But bulls, they need to continue the strength of 77. Really easy to get chewed up in situations like this. Most traders are just better off being flat. By the time you think it's bearish, it can quickly go the opposite direction. Well, looks like I was wrong. I mentioned that we'd probably test the open of the day, and instead we're doing the opposite. But I am not going to do anything here. Far too late in the day for me. Well, looks like the battle is going to be over yesterday's high and yesterday's low. Not really all that surprising. I thought we would close below the open of the day, and obviously I was wrong. But, oh well. Daily chart, the bulls are getting follow through, but it's getting a little bit far. We may have to get up to 5,600, and then we may go sideways there. But overall, it's getting a little bit climactic, and that makes me think the market's probably going to pull back fairly soon. Tomorrow's a holiday, so the market's closed, and then trading will resume Thursday and Friday. Weekly chart, good looking bar for the week. But I think the reality is, I think this whole thing is going to be a trading range. And even though the bulls have done a good job and the market's rallied quite a bit, I think we'll probably end up being sideways. It could take weeks to do that, but we'll probably get back in this area, 5,400, fairly soon. Daily chart, or 5-minute chart. Bar 1, we had a bull bar closing on its high. And yesterday had a strong bull trend for most of the day. And I thought the odds favored that today would have a lot of sideways trading. So 75% chance today would have sideways trading or a trading range lasting 2 hours beginning before the end of the second hour. And a 50% chance of follow-through buying on the open, followed by sideways trading lasting 2 hours. Only a 25% chance that today was going to be a bull trend day. Bar 2, we have a bull bar closing. It's a bull bar, doji, but probably buyers below 2 and a second leg up, but trading range, so I expect disappointment. Bar 3, an outside bar, doji. So we have a 1 bar breakout, bar 1, and we have 2 overlapping bars, bars 2 and 3. That increases the risk that we may start to go sideways here. 4, bear bar, closing on its low. Good for the bears, but probably buyers below in a second leg up. Because of 2, let me make this bigger. Because of 3 and 4, we may get a small second leg down. 5, a bull bar, but I suspect sellers above 5. And then 6, outside down, but a second leg, possibly 2 legs. Leg 1 to bar 4, pull back 5, second leg 6. So there might be more buyers below, and then we lead to a second leg. 7, bull bar, but there might be more sellers above 7 than buyers. I do think we're going to go above the 3 high, but we may end up forming a trading range for a while. 8, bull bar, inside bar, tight trading range, starting to go sideways. 9, a bear bar, but a doji, so tight trading range, buyers below, sellers above. 10, bear breakout closing on its low, probably going to go sideways. 11, follow through buying, follow through selling. Good for the bears, but I suspect the downside is probably limited, especially after 81 in bar 1 and 2 today. 12, bull bar testing the open of the day, and we reversed up. What about selling above 12? I would not. It may just be a failed breakout of the tight trading range over the past 7 bars. 13, bull bar, closing on its high. Good for the bulls, but trading range. And look at every bear breakout and bull breakout today. Big bar 1, bad follow through 2 and 3. Big bars 10 and 11, bad follow through 12 and 13. 14, bad follow through after 13. Increases the chances that we go more sideways. And you can see 15 was the second leg down after 10 and 11. 15, do you sell it? And it's possible double bottom, and therefore there might be more buyers below 15 than sellers. Until we get a clear breakout with follow through, there is no breakout. 16, a bear bar, you call it, well, it's a doji. Probably sellers above, buyers below, scaling in lower. And then 17, we broke below 1, we broke below 16, and we formed a tail, increasing the risk that there's buyers below. 18, doji. So the momentum is decreasing, which increases the probability that we're going to bounce. Outside down, 19, but a trading range bar. Outside bars are expanding triangles, which are a form of trading ranges. And that increases the probability that there's more buyers below 19 than sellers. 19, a doji, weak stop entry buy, but a second entry. And ever since the sell-off down to 15, we're getting a lot of overlapping bars. Really, for every bar except bar 1, we've had a lot of overlapping bars, and that increases the risk that there's buyers not far below. 21, bear bar, probably going to go sideways, and then 22, a bull bar, and you can see we went sideways for the next several bars. We tried to get an implied low 2 with 24. You can call it several ways to call the low 2. We pulled back, tried to sell off 22, rallied, tried to sell off 25, 26. 26 is a bull breakout, and it's a bull breakout above the moving average, above the bear flag. 24 increases the probability that we're going to go at least a little bit higher. And then 27, follow through. Are we always in long? I think we are, but it's not really clear. Trading ranges are notorious for becoming always in long, and then right when it's clearly always in long, the market reverses. So traders front run, they anticipate the reversal, and they enter early. 28, 3 consecutive bull bars, 26, 27, 28. Is it by the close? Probably. But 3 consecutive bull bars getting near resistance, we may have to pull back first, and that's what we did with 29. 29 outside down, but probably buyers below, and then 30 outside up. Good for the bulls, but at the top of the trading range. And we have 3 overlapping bars, 28, 29, 30. And that increases the risk that we're going to go sideways. 31, bull bar, good for the bulls. 32, follow through, but possible parabolic wedge, 24, 29, and 32. Increase the risk that the market starts to go sideways and possibly pulls back. 33, a little bit of a surprise. Okay for bulls to exit, expecting a couple of legs sideways to down. 34, follow through. What about selling? Well, if you're selling in the middle of the trading range, and the pullback could be deep, but consecutive bear bars, 33, 34, we'll probably get at least a small second leg down. What about buying? 35? I would not. To me, 35 is a trap. Trapping bulls, trapping weak bulls into buying and weak bears into exiting their shorts. Probably going to get a second leg. Outside down, 36. That may be all of the second leg we get. What about selling 36? Selling 36 is selling right at the open of the day into support. And the channel up to the 32 high was fairly tight. Therefore, there might be buyers in this general area. 37, bull bar, doji, probably going to go sideways. For the bulls, they'll see it as 2 legs down. 33, 34, pause 35, and then 36, 37. 2 legs after a rally up to 32. So they'll hope that 37 is a higher low that leads to a test up to yesterday's high. We got a doji, 38, low 1, breakout pullback sell. Some of the bears who sold to close at 36, disappointed with 37. And you can see they used 38 to buy back some of their shorts. The bulls, they saw it as a bad low 1, breakout pullback sell. They anticipated bears being disappointed, so they bought as well. 39, doji, small second leg up after the rally on 37, but probably buyers below 39 and higher prices. Bear bar on 40. For the bears, it's a 3-bar micro channel, probably buyers below. You're near support, and that lowers the probability for the bulls. And then we got a bull bar on 41. For the bulls, I think a lot of bears get out above 41 if they're still happen to be short. And that'll increase the risk that we go sideways to up and get another leg. 42 consecutive bull bars, probably buyers below 42 and higher prices. 43 outside down, we tested near the 32 low and we pulled back, no surprise. Low of 32, 55 even, high of this bar is 55.5. What about buying below 40? What about buying below 43 or selling above 43? I would not. Middle of the tight trading range, better to wait and do nothing. Bull bar 44, middle, it's a triangle, many ways to draw it. We're getting lower highs, higher lows. We have an obvious magnet of yesterday's high above, and that increases the chances that we're probably going to get there. 45, an inside bar, probably going to go sideways. 46, bull bar closing on its high. 47, outside up, good for the bulls, probably going at least a little bit higher. And then 48, we have a doji. For the bulls, probably, for the bulls, it's an inside bar. Probably sellers above. Let me back up. For the bulls, inside bar. This looks like a leg in a trading range. I suspect there's sellers above, but the sellers may not come in until we get to yesterday's high. So not really ideal. 49, bear bar. Probably going to go sideways. 50, breakout above 49, breakout above 47. I suspect buyers below. We're so close to yesterday's high that we're probably going to get there, although this does look like a wedge top. And it looks like a weak bull channel, and therefore we may break above the channel and fail. Inside bar 51, every time we break to a new high, we pull back, breakout, 47, pull back 48, 49, breakout 50, pull back 51, and then breakout 52. Good for the bulls, but look where you are. Yesterday's high and a leg 1, leg 2. From the low of 21 to the high of 32, pull back 37, and then the high of 52. 53, outside down. Do you buy it or sell it? I think always in bulls, exit below 53, and bears will sell, taking a chance that we break below the open of the day in the 21 low. Failed breakout of yesterday's high. Good follow through 54, at resistance, probably going lower. And then you can see 55. Traders were giving up. However, whenever you get a bar like 55, it's a really big bar in an overall trading range day. And a lot of the bears who sold below 53 or 54, they'll look at 55 as a gift. It's a big bear bar. Whenever you get really big bars, it increases the climactic behavior of the sell-off. So if you look right here, big bear bar, big bear bar. These bars are consecutive. There's 2 or 3 bars. These bars are big, but they're all the same average in size. And because of that, it increases the risk that you're going to get 2 or 3 legs down. Here, this is the problem with trading ranges. You get these really big bars. It's a 1 bar sell climax that leads to a deep pullback and then a retest. So here, big bear bar, strong enough bar, we may get a second leg down, but with the tail being below, it's a strong enough reversal that we may get a couple of legs sideways to up. And then big bull bar closing on a tie, 56, good for the bulls. Probably sellers above, but I suspect buyers not far below, and that will limit the downside. 57, low 1, but probably buyers below. 3 consecutive bear bars at the 55 close, but all have overlap, probably going to pull back. And then what's what would happen on 61. 61, you had bulls buying below. You had also bulls who bought above 56, and they bought more below 56, and that's why we pulled back here. Are there more buyers or sellers above 60? And there's probably more sellers above 60, but we could easily test all the way up to the 55 high. So as far as selling the 60 high, I'd rather look to sell higher. And then probably buyers below 61, 63, doji. We may try and get the downside breakout, but so far, no strong stop entries up or down. And then we got a big bull bar 66, but we reversed down sharply on 67. Tight trading range, 56 through 65. So you know, tight trading range, it's a triangle. We broke out of the triangle 66 and reversed down sharply 67. So it's possible that we get a plunge below the open of the day, test the 55 low, and test the low of the day, bar 21. And instead, we got bad follow through on 68. 68, bad entry bar for the bears, increasing the probability that there's more buyers below 68 than sellers. And then 69, bull bar, there might be sellers above, but middle of the trading range, you're in the bottom portion of a trading range after several attempts down. So we could easily test the top of the range. And that's what we did over the next several bars. 72, we broke above 67. But 67 is a big bear bar. Bears selling the close, probably selling more higher, increases the chances that we sell off back to the 67 close. And instead, we found buyers below 72. Why? Because it's a 4 bar, it's really a 5 bar bull micro channel. Bad stop entry below 72. Therefore, increases the risk that there's buyers below. And then we tried to go outside up on 73. For the bulls, what about buying above 73? Well, 73 is overlapping 72 by a lot, and that increases the chances, especially with 73 triggering the sell below 72. That increases the risk that there's more sellers above 73 than buyers. We also have resistance, the 53 low, not far above. And you can see that doji said the 53 low is 58.5. The high of this doji, 74, is 58.25. So we came within a tick of this low. 75, we went above 74, and then we reversed down. Good for the bears. It's a swing sell below, low probability. We may plunge back to the open of the day in the final minutes. And instead, we went sideways and tested to yesterday's high. And the bulls, you can see they got a close, 1 tick above yesterday's high. High of this bar is 61.5. Close of today, 62 even. but a lot of overlap, that'll be disappointing for the bulls. For stop entries, really bad stop entry day. If you buy above 1, I would not. Better to wait for follow through. What do? You probably get out anywhere. You buy the close at 1, then you see 2 and 3. A lot of traders, when they saw the follow through 2 and 3 after 1, they ended up just selling, and that's why forward reverse down. And you can sell below 10, but trading range most likely. We sold back to the open and reversed up. I think a lot of traders, if I'm selling in a tight trading range, especially below bars or buying above bars, I'm going to be pretty quick to get out. It's basically an aggressive entry trying to get in early. But if you're doing that, if you start to see the market pull back, a lot of traders just exit wherever they are. No clear stop entry buy here. Some traders, they sell below 11. They might put a stop above 6 or a stop above 3. Big bull bar 13, but possible second leg after bar 1 and 2. And that would allow, it's a possible second leg, allowing the bulls who bought up here, disappointed, scaling in lower to get out break even. Reversal below 14 and 15, some bears will sell. But if they do, not clearly always in short, down here in 21, it's starting to become always in short. But when the market starts to look like it's always in short in an overall trading range environment, usually it's better to look to do the opposite. And so a lot of traders start buying back shorts and bulls start buying to go long. You can buy above 25, but a little bit aggressive. Better to probably buy above a bar like 27, breakout follow through above the moving average. However, if you're buying there, you're buying in the middle of the trading range, and you've got to be quick to make decisions. A lot of traders, they get out a couple of points below 32 or below 33. Bears, if they short below 33, they get out above 37. Aggressive bulls can buy there, or they can buy above 41. And where do the bulls get out? I think they definitely get out below 53. And 53 was probably the single best stop entry of the day. It was a clear failed breakout of resistance, yesterday's high. And there were reasons for the market to test lower. Several reversal attempts down, failed breakout of yesterday's high, and the high of bar 3. So overall, good trade. Always in bears, they sell below 53, but they probably get out. Some get out above this bar, others get out anywhere in here. And then bulls, they can buy 69 or 71, but a little bit tough. They probably get out below 75, and that's probably it for stop entries. Stop entries in a trading range are all minor reversals, which means the trades are rather aggressive. And when you're trading minor reversals, you're counting legs. Whenever you're in a trading range, you're counting legs. You're looking for wedge bottoms and double bottoms to buy. You're looking for double tops and wedge tops to sell. Limit orders, you could basically, everything was a limit order. Especially once you start to see 2 or 3 legs sideways to down, 2 or 3 legs sideways to up. Traders buying below bars, scaling in, scalping out, selling above bars, scalping out, buying below 17, 18, buying the close of 22 for a scalp. And then here we had a micro channel, so you really couldn't buy anywhere. Some bulls, I think it's okay to buy below 28 here, 51 and a quarter. Bulls will buy there, expecting a bounce. Probably sellers above 35. I thought that was reasonable, but really tough. You have trapped bulls who bought the close of 33 and may have scaled in on 34. And so a lot of bulls, because it's a breakout and follow through, 33, 34, they'll look to exit on a retest of the 33 low, which is the equivalent of selling above 35. So a lot of sense it made sense to get a second leg. I thought buyers below 39 was logical, buyers below 42, and selling the close at 52 was a little bit aggressive, but context made sense. Failed breakout of the bull channel, 42 to 50, and a test of yesterday's high after consecutive buy climaxes in a second leg, leg 1, pullback, leg 2. Buyers below 57, buyers below 58 or 59, and then really buyers below bars, sellers above bars, and overall sideways trading in here. Buy the close, sell the close. Maybe 27 was buy the close, maybe 32, sell the close, but really tough. Sell the close 54, that made sense. And that's probably it for buy the close, sell the close. Everything else was an opposite. So you see a bull bar, you sell it. You see a couple bear bars down, you buy it. Let me take a look at questions. Okay, question. This one's a little bit long, but I'll try and give as best of an answer as I can. Whenever the questions are long, it's more tricky. It's try to make the questions shorter, because if you make them really long, then I have to repeat it, and then it's easy for people to tune out with the question being asked or get mixed up on what the question actually is. So it's more for the interest of the audience. Okay, the question, so I'm going to try and summarize this question and break it up into pieces. Is there a good way to, so here's the question. Is there a good way to identify potential trading range tops and bottoms? I'm not sure in trading ranges if it's better to look. So how do you identify trading range tops and bottoms? Well, there's a lot of different variables, but the biggest piece is, let's talk about how we identify a trading range. What do you think the easiest way, for those of you in Discord, what's the easiest way to identify a trading range? What's the one thing on this chart that we see that makes a trading range obvious? That implies the least amount of thinking. Okay, bars overlapping, that's true, but what else? Is there something on this chart that we can see and we can measure based on the slope? Yeah, flat moving average, good job. And whenever the moving average is flat, that increases the probability that you're in a trading range. And I break everything up. I'm going to record the Orlando presentation fairly soon. And the one goal I'm going to have with explaining always in is understanding major and minor reversals. Minor reversals shift very quickly because it's minor. It implies a trading range. So when you look at a day like today, the way I look at it is when I see 2 or 3 legs sideways to down, like a bear breakout 15, and then I start to see sideways to down bars, we pause on 16, and then we have a second leg down, 18, and then we went above 18 on 19, and then we got another leg down, 21. That's 3 legs down. 1, pause, 2, pause, 3. You could say 1, 2, 3 if you want. Point is, we're becoming always in short, but we're just not doing enough. And we try to form a bull flag, a bear flag, and instead we break to the upside. So what I look for is that one side's become exhausted. When I see a rally like this, let's go over here. When I see a rally like this, the only way I'm going to sell it is if I start seeing a lot of overlap, and then I like to, in general, I like to wait for a stop entry. So the way I think about how do you identify trading range tops and bottoms is trading ranges are filled with clusters, zones. You could buy below 12. 12 might be the bottom, 1 might be the bottom, 81 might be the bottom. So what I generally do is wait to count the legs. I look for a breakout, 15. It's probably going to get a couple of legs sideways to down, 18, 21. Those are the 2 legs down. And then I think, what would I do if I was a swing trader? If I was a swing bear, if I sold below 14, how am I going to manage the trade? And if I look at this and say, there's no way I'm going to be long, I'm going to get out above a bar. And that's how I would manage those. Okay, so if it's better to look for if it's better to look for failed breakout to set up. So point is, they're saying, is it better to look for failed breakouts below support and resistance, or is it better to trade in the direction of the broad channel? Well, in this case, it's flat. And I'm not swing trading. The other thing I think about in trading ranges is risk. I'm always thinking about risk reward. And if I'm short, I mentioned this, I don't remember where exactly. I think I mentioned over here, 36. I said the problem for the bears is risk reward. If they're short, stop above 32. 1 times the risk is all the way down here. It doesn't matter if you sold the close. If you sold the close of 32, your risk is now the close of 36 to the high of this bar. And because of that, a lot of traders are going to take profits. One of the things that screws traders up is they think about break even too much. In other words, they don't measure their trade in terms of risk from the market price to their stop. They like to think about break even. And what they'll do is they'll sell a bar like 53, and put a stop above, and they'll trade a full size position, and then they fail to recognize that this bar is getting so big that now the risk is getting so large. Even though the risk is open profit, it's getting so large that a lot of those traders, they don't realize that, and they end up not taking profit. Same thing up here. If you're buying and your stop's down here, even if you bought here and the rest of this is open profit, it's still risk. So I think the easiest way to identify what helps is, one thing I do is I look at every bar, and every bar that goes by, I always ask myself, if I was flat, would I buy here? If I was flat, would I sell here? So if I'm long, if I'm long, even if I bought anywhere the close of 21 and I'm still long, I'm still looking at this and asking myself, if I was flat, would I buy right here, right now? And if the answer is no, I have to exit the trade. But these days are limit order days. They're not good swing trading days. Okay, question, do you ever trade the 1 minute chart on days like this? Yeah, I looked at the 100-second chart various times today. That's something I'll do pretty regularly. And, why will I do that? It's generally when I'm trying to, there's a decent, so how do I trade the 1 minute chart, or I like a 100-second chart or a 2 minute chart. The reason I like a 100-second chart is it's divisible by 5, so there's 3 100-second bars for every 5 minute bar. And what I look for is, I took a trade up here on a 100-second chart, and let me try and load it. I took a trade up here on a 100-second chart, and let me try and load it. So this bar is 52 or 1250. We'll see if it loads. But point is, what I look for is, I bet I can do it on a 2 minute chart. This will be close enough. So what I looked for is, we basically had consecutive buy climaxes. We had a rally that looked fairly strong here. And whenever you get a rally late in the channel, let me just see. I'd really rather talk about it from the way I saw it. There we go. Cool. So here is this 100-second chart. And you can see we had a rally, pause, bull bar after in a bull channel, and important resistance above yesterday's high. And then we got a bear bar, another bar, another bar. Once we start to get 3 consecutive bear bars, traders start to sell the close. Or even some traders, if they're more aggressive, they get a bear bar and follow through. They sell the close of this bar, betting that it's a bad high one and we'll get a second leg. Other things that I'll do is try to find examples. Like here, sometimes when I think the odds are this rally here, which is the equivalent of this rally to bar 32. What I'll do is I'll wait and see a couple of legs down, and then sometimes I might try and front run, buy as the market's going up, taking a chance we race up, and then when it starts to stall, just get out. But they're all pretty much scalps, and they're all scalps based on a 5 minute chart, just trying to get a better entry. But most of my trades are based on the 5 minute, and I'm just watching the 5 minute. Let me take a look at more questions. Okay. Question. On the first leg down from 53 to 55, so 53 to 55, this sell-off here, is the second leg not from 57 to 59 here? And then we reset the count? Yeah, well, so overall, I thought that the sell-off, let me say a few things. One, I thought this sell-off as it was forming was strong enough for a second leg. But then something really important happened. What happened is, I bet I can show it on a 100-second chart. So let's just do that. that's what happened. We sold off and pulled back. And that tail below the bar is basically this right here. This bar right here. That's a strong enough reversal that it's probably going to get a second leg. And because of that, you have a strong enough reversal, you expect a second leg, probably buyers below. You can call this the second leg down, but in this case, it's pretty much trap trader. So the way I think about it is it's a buy below 59. Why? Because you had sell to close, bears selling, scaling in, disappointed, getting out, break even. You could argue we never got a second leg down. We tried here, disappointment, and then we tried here again, disappointment. And you'll notice it's basically a variant of a higher low, double bottom, higher low, major trend reversal. Bear trend, trend line break to 57, retest to the low 60, 55 even, and then look at here, 55 even. So if you're a bear and you sold the low, somebody on some time frame, unfortunately, happened to sell the low of 55. And what are they going to do? They scaled in higher. And then they look at 60. And instead of getting out break even, which a lot of traders did, those bears stayed short. And then they were disappointed all through here. And then look what happened on 68, 69. It retested that exact price once again. And that's what led to this rally here. But overall, instead of getting a clear second leg, we formed a tight trading range and entered breakout mode. But you can certainly call 60 a second leg down. So tomorrow's a holiday. But overall, we have enough buying. It's a strong enough bull breakout follow through that we may go a little bit higher. But my concern is, while we'll probably go higher, I suspect buyers below. So my concern here is consecutive buy climaxes and we get a reversal down. I think the downside is going to be limited. So even if we sell off to the moving average, we'll probably have to rally all the way back up here. But I don't know how many traders are going to be thrilled about buying up here instead of buying closer to support, like the moving average. Okay, so one final question for today. Brad, can you explain once more the logic behind buying after bear bars, buying bear closes and selling bull closes, and still making money, and how you utilize that in trading? I've tried this on Sim, but I was a little bit surprised. I'm not exactly sure of the question, but I think what you're asking is, can you talk about how traders can buy and sell, both traders can buy and sell and generally make money? Yeah. So if you think about it, bulls can buy the close of 13 and buy more above the bull bar closing on its high, maybe 25, maybe 23, maybe above 26, buying anywhere, and then exit on the retest. Bears, they can sell below bear bar 19, be very disappointed by the rally, and look what happened. If they sell more below another bear bar, they can get out break even here, or maybe they sell here. So what's the whole point? The point is there's a difference between a day like this and a day like this. Days like this, what happens to limit order bears? Limit order bears get absolutely crushed on days like today. And that increases the probability that when you have trap traders, it leads to more and more buying. On a day like this, everything's forgiven. And that's because of what I talked about. By the time the market's clearly bearish, it reverses. By the time it's clearly bullish, it reverses. Because of these, the reason why traders don't like to buy bull bars on 31, 32 up here after 2 or 3 legs up is because they expect a deep pullback. The reason why they don't like to sell down here is because they expect a deep pullback. And that is what leads to all these reversals. The bears selling, scaling in higher, getting out break even. The bulls buying, scaling in lower, getting out break even. That's what leads to the pullback here. And that happens just all day long. Bulls buying here, they buy more as 55 goes down, more at the open of the day, and then they exit on a retest of the low of 53. Okay, so we will see. It'll be interesting to see how the rest of this week plays out. We have a strong bull bar on the weekly chart, but it'll be interesting to see how this bar ends up closing. I think it will probably get a tail on the bar. So I think the weekly chart will be a little bit disappointing. Okay, hope everyone has a great rest of their day, and I'll talk to everybody soon.